Chairman Grunberg has been a strong proponent and supporter of conducting high-quality research that sheds light on issues facing consumers. And without further ado, please join me in welcoming FDIC Acting Chairman Martin Grunberg.
Good morning and welcome to this 11th Annual Consumer Research Symposium. I'm really delighted to have the opportunity to welcome you all this morning. Each year, this event provides an important opportunity for FDIC researchers to engage with and learn from leading scholars in consumer finance, an area of high priority and attention for the FDIC. If I may, let me start by thanking the organizers of this event. Planning for a symposium of this size is always a lot of work, but the amount of effort required is even greater for a virtual symposium, which is what we are presenting to you all today. Work on this year's symposium was led by Karen Chu, the Chief of the Banking and Consumer Research Section in the FDIC Center for Financial Research. I appreciate, in addition, the hard work by the FDIC economists on this year's organizing committee, Garrett Christensen, Ryan Goodstein, and Mary Zaki. Finally, let me recognize the work of Ebony Oliver, Donna Vogel, Dave Spanberg, and Glenn Kivlin for managing countless logistical details, including the website and the technology for our virtual event today. I would also like briefly to mention other research activities at the FDIC for your awareness. In addition to major events like the one today, the FDIC hosts an active seminar series, publishes working papers, and offers opportunities for PhD summer fellows and visiting scholars to come to Washington to engage with FDIC economists for an extended period. I would encourage the researchers in our audience today to pursue these opportunities for collaboration with us. Our goals for today's symposium are twofold. First, to provide a platform for academic research in consumer finance, and second, to expand our understanding of and capabilities in this important field. I want to emphasize the importance of research to the FDIC. High-quality research is foundational for good policymaking. As policymakers and regulators, we rely extensively on our own research and the research conducted by others to inform our discussions and deliberations. Consumer research in particular helps build a strong foundation for our core mission responsibilities of consumer protection, community development, and financial inclusion. This symposium today is an integral part of our engagement with this consumer research. When we started planning this year's event in 2021, we had hopes of hosting this symposium in person. Sadly, that has not turned out to be possible. However, we are not constrained by physical space limitations and have the opportunity to welcome a much larger audience as a result of our virtual presentation. All of you will help us usher in a second decade of highlighting policy-relevant consumer finance research on topics that are important to the FDIC and to the financial system more broadly. This year's symposium attracted an exceptionally strong set of research paper submissions from authors all over the world. We had nearly 190 submissions in total. This is a new high for us and underlines the importance of this symposium to the field of consumer finance research. Only 15 papers were selected for our program today, which speaks to the competitiveness of the field and the quality of the research that will be presented. I thank everyone who submitted a paper and congratulate the authors who are presenting papers. Let me also extend a special thanks to the discussants on this year's program. They will be synthesizing the papers in their session and placing them into a larger context. Over the years, the contributions of our discussants have set our symposium apart from other events, and I'm confident this year will be no exception. We have several stimulating panels today on topics arranged around timely and important issues, including mortgage market and housing challenges, alternatives to bank credit, student loans, and retirement savings. For me, a highlight of today's symposium is the keynote address from our distinguished guest, John Friedman, professor and chair of the economics department at Brown University. Dr. Friedman will be presenting his work on the economic impacts of COVID-19, evidence from a new public database using private sector data. It goes without saying that this is a topic of importance to the FDIC, and I'm confident we'll all learn a great deal from the presentation. Let me close by thanking all of you in the audience for attending today's symposium, even if we can't see you in person. We have a record number of registered attendees this year, more than 560. Our attendees come from a variety of backgrounds, including regulatory and policymaking institutions, nonprofit institutions, academic institutions, and the private sector. We encourage all of you to share your perspectives on the research discussed today and their practical implications. We value the perspectives that all of you bring, and I look forward to robust discussions. Now, if I may, let me turn the podium back to Mark, who will introduce our keynote speaker. And once again, thank you all for participating in today's program. Thank you very much.
Thank you, Acting Chairman Grunberg. I want to echo your sentiments and particularly note my appreciation for the work of the researchers and the leadership from the Division of Insurance and Research that have given us today's program, and for all the participants that we'll learn from today. And now I have the honor of introducing Dr. John Friedman, who will provide our distinguished guest lecture. Dr. Friedman is the PDBF Distinguished Professor of Economics and International and Public Affairs at Brown University. His work has appeared in top academic journals and in major media outlets, and he's helped to shape policies at every level of government. In fact, he may be the only speaker in the history of this keynote role to have had his work cited during a presidential State of the Union address. Dr. Friedman has also distinguished himself through public service, having served as Special Assistant to the President for Economic Policy at the National Economic Council in the White House. He's a research associate at NBER and a co-editor of the profession's flagship journal, the American Economic Review. And he's also the chair of the economics department at Brown University. So he's got lots of jobs to do. Along with Drs. Raj Chetty and Nathaniel Hendren, Dr. Friedman is a founding co-director of the Opportunity Insights, a nonpartisan, not-for-profit organization based at Harvard University. The organization conducts research using big data to improve economic opportunities for all Americans and works collaboratively with local stakeholders to translate their research findings into policy change. Recently, Dr. Friedman and his colleagues at Opportunity Insights published the Economic Tracker, a resource for the research community and for the public alike, which provides a granular and nearly real-time look at how COVID-19 is affecting the economy in cities and states around America. We've invited him to discuss this work, highlighting how the economic effects of COVID-19 have differed, for example, across consumers with various incomes. But before I hand over the floor, I want to let you know that we'll have time for audience questions immediately after Dr. Friedman's remarks. And if you'd like to ask a question at that time, please use the Q&A text box or raise hand feature in WebEx. Each of these platforms operates a little bit differently, and so take a look at how this one works, and hopefully we'll have time for a robust discussion. And now, although it's hard to do virtually, I know you'll join me in welcoming Dr. John Friedman. Dr. Friedman?
Thank you so much for that generous introduction, and thank you for having me here. And it's a pity that I can't be there in person, but hopefully is a way to, as the chairman said, kind of share the great research that is going to be featured throughout this conference with more folks. So, as said, I'm going to try to talk about what COVID-19 has done to the American economy over the last 2 years. And I'm going to do that by using data from a new public database that we put together to try to help measure what's going on in this instance and hopefully in future instances in a much more granular way. So just by way of introduction, for the last, 80 years, macroeconomic policy has been based primarily on survey data from households and businesses, right? And if you actually go back and read the start of this with, the work of Kuznets and others in the Great Depression, there were really no economic statistics. And he and others started by thinking, how could we get more information? How can we have some sense of what's going on? And that grew over time to become the basis of the set of national statistics that we have today, which are an incredibly valuable, incredibly well-run set of information. Still, I think as we enter the age of big data, there are limitations to those statistics that may not have been noticeable, going back, 10 or 20 years. So the first thing, which I think everyone really noticed, really in the heart of the crisis in April 2020, was that a lot of these statistics are only available at relatively low frequencies. So, for instance, people wanted to understand what was happening to the economy, but 2020 second quarter GDP estimates weren't going to come out until July, end of July, and it was just really difficult to, at the moment, for instance, when Congress was considering the CARES Act in late March 2020, it was difficult to get a sense of what was going on. Now, that was really what motivated us to get into this, but as you'll see, I think what for us has really become, the key in value in a lot of this was not just the ability to look at higher frequency, but to look at things at a greater level of granularity than is otherwise possible in the statistics. And especially if one is interested in thinking not only about the overall effects of the COVID-19 recession, but on how it has differentially impacted consumers and businesses in different settings to the extent that it's amplified or limited inequality, it's really important that we be able to do this. And so, of course, there's a lot of great work that's been done on the pandemic, much of it using some of these new, administrative kind of private sector data sets. I think what's different here is that we're going to try to do some of that analysis, but also produce what is a publicly available database so that we and anyone else can look at these statistics as they roll out at a weekly or a monthly level, depending on the data source. And I'm going to then talk through kind of examples, not only of how we construct the database, but also how I think it's useful in this context and how I think it might be useful going forward. So I'm going to go through this in 4 steps. First, I'm going to tell you about just the data and kind of how we get to what you'll see online. And then from there, pretty much everything we're going to do works with those publicly available data. I'm going to first talk about the impacts of COVID-19 on the economy, focused mostly kind of on the first few months of the recession. And then I'm going to give you a case study for what I'll call real-time policy analysis, which uses these data to measure the effects of the fiscal stimulus in a way that I actually think was soon enough to feed back into the policymaking process. And then if we have some time at the end, either in these slides or in the Q&A, I'm happy to talk about, the current situation, where I think we are now and what the challenges are. So let me start with the data. So we're going to get data from a number of different sources. And again, the key thing I just want to reemphasize here is that all of this is going to be done with public statistics. So we're taking in data from a number of private sector companies. We're then going to process it in a way that I'll say a little bit more about in a second. And the challenge of all of this is to produce a set of public statistics that are sufficiently granular for research, yet sufficiently aggregated such that both we are not worried about privacy of the underlying consumers or businesses or employees in the data set, but also, sometimes the companies don't want to be giving out too much of their internal data either. And so, the balance is kind of how do we create something that can be this public good while respecting essentially the privacy of all these different organizations. We combine data from, here's the set of companies. And so I'm going to focus mostly on the first three set of series here. So we're going to use primarily data from Affinity Solutions for consumer spending. Affinity Solutions is a kind of credit card aggregator that gets information essentially from like the bank credit card statement that you see at the end of every month. And we think covers about 10% of U.S. card purchases. Then we're going to learn about small business revenues from Womply, which is a payment processing aggregator. So you stick your credit card into whatever is the device at a local store, and then there's a company that helps connect that with the credit card network. Womply aggregates data from across lots of different those processors. Again, we think they are capturing something like 10% of U.S. Card action. We have a number of different data sets and partner companies when measuring employment. And the key thing here is these are all these are kind of employer side data sets. So Paychex is the second largest payroll processing company in the country. They also cover about 10% of U.S. payroll. And then EarnIn, Intuit, and Kronos help to kind of fill in some of the gaps where Paychex is missing. So what do we do when we get all of these data sets, right? In no case can we just take a data set that the company sends us and kind of, plop it up on the web. We have to go through a series of steps in order to construct series that are suitable for economic analysis. And so we clean the series to remove artifacts that arise from these type of transaction data. So just to give you an example of that, sometimes new payment processors or new partner banks come into the consumer spending or the small business revenue series. And so, you can look in the data and see things jump in particular places when those new banks come in. And then we have an algorithm that goes through and removes that type of stuff. We also smooth seasonal fluctuations using prior year data. This is something that we're doing in a relatively simplistic way just because of the limited time series of our data, but that's something where I think, these methods can improve a lot going forward. We also, we never give aggregates. To kind of protect the, privacy of some of the underlying companies, we index everything in the public values to January 2020 values. And so, for instance, we're going to see that things are, down 10% or up 10% rather than just with the, the raw aggregate values. We also exclude small cells, and we combine data from multiple companies, for instance, in employment, in order to help out here. And then the final step, just to make sure that what we're getting is something that really has economic content in it, is we benchmark to some of the national statistics that, we've all relied on for many years to make sure that we're getting something that is representative. Now, this is a little bit challenging because, the whole point of this is that many of these series do not exist at the granular levels that that we're interested in studying. But, just to give you one example of how we do this, this chart plots our consumer spending series from Affinity Solutions against data from the monthly retail trade survey. So here in green, we're doing this for the food and accommodation sector. And, that's obviously a sector that was hit extremely hard in the Great Recession, right? You see that spending, fell by more than 50% in that sector in both of these data sets. But what you can see here is comparing our Affinity Solutions series in the solid green line with the Advanced Monthly Retail Trade Survey series in the dashed line. You see that, things are not right on top of each other, but they're tracking each other pretty well. Very large drop followed by, a sharp but partial recovery, and then things start to tip down again at the end of 2020. And that looks very different from what we see in the retail sector, where, both series are going along. You see, here in December 2019 is the holiday spike. And then you see actually that there's really no immediate effect of the crisis then there's actually an increase of spending in both series, the Affinity Solution series in the solid, gold, and the MRTS in the dashed line, such that retail spending, once you get to May, was really consistently above the pre-pandemic benchmark going forward. And so I'll return to benchmark some of the employment series a little bit later. You can read a lot more of that on some of the materials we have on our website. But broadly, we feel that we're doing pretty well in terms of producing a series that here is at least pretty representative across these different sectors. So the first way in which I'm going to apply these new data is to try to understand what exactly it was that COVID-19 did to our economy. What are the pathways through which these effects happened, thinking now back a little less than 2 years ago, and what was the effect on different households, different employers, different employees. So just to start, this is just a raw plot. This is kind of the only aggregate plot I'll show. What we do is we take that Affinity Solution series and then we scale it up to kind of represent all of consumer spending. And then importantly, we're going to split things in this plot. This is an example of the type of thing you can do in these data that you can't do in some of the BEA series. We're going to split things based on household income quartile. And specifically, the way we're getting that is based on residence. So for individuals living in kind of top income quartile places, pre-pandemic, they were spending about $8 billion a day on cards. And we've got the dashed line here is the 2019, which is, I think, a good counterfactual visually here. And then in the solid line is what happened in 2020. And so what you see is that immediately upon the impact of COVID-19, spending falls by about 40% for these high-income consumers. That's a deficit of about $3 billion a day of card spending. It then recovers, reasonably quickly over the next 6 months. But by the time you get to fall of 2020, we're still operating at about $1 billion a day deficit for this group of consumers. And what I've noted here is that if you think about the aggregate spending deficit in October 2020, this $1 billion deficit among high-income households represents about half of the aggregate decline. And then you see going over to the right here, by the time you get to summer 2021, you see that spending for high-income consumers at that point has returned to the kind of the seasonally adjusted year before counterfactual. In contrast, if we look at spending patterns for low-income households, we get a very different picture. So the first thing, of course, is that low-income households are spending much less per day. That's not surprising by definition. That's what's going on. But what we see here is, first of all, the spending decline at the beginning of the pandemic is both less deep and less long-lived. And so there's about only a 30% decrease in spending as opposed to a 40% decrease for the higher income consumers. And it returns very, very quickly such that it hits the baseline by June 2020. And so fast forward to fall 2020, low-income consumers are actually spending exactly what we think they would have spent the year before. And then once we get past January 2020, when some of the new stimulus bills kick in, and we're going to return to this later, you see this kind of very sharp increase here. We think that low-income consumers have actually been spending more than baseline for much of the past year. And so kind of especially through the first year of the pandemic, a lot of the spending decline is coming from high-income individuals, both because proportionally there was a larger pullback in spending, but also just because mechanically they are a larger share of overall spending. And I'll come back to that in a bit. What did they stop spending on? Well, I think it's not surprising that most of the pullback in spending was on in-person services. So we've broken out the change in consumer spending in the first month of the pandemic by sector, and about 2/3 of the decline in spending comes from various in-person services. And just to have a benchmark, this bar on the right gives the distribution of pre-pandemic spending. And so, roughly these in-person services accounted for about a third of pre-pandemic spending, but were 2/3 of the pullback. And so that gives you a sense of, how locally concentrated these pullbacks were in these particular sectors. And, just as an aside, this is something that I think, may be obvious in retrospect, but I think it's worth noting how different this is than what happened during the Great Recession, 10 or 12 years ago. And so just to give you a sense, the gold bars here are just showing you across these somewhat broader categories where the change in consumer spending came, right? It's mostly in services with a little bit in durables and non-durables. The Great Recession was essentially the opposite. In the Great Recession, services essentially were not affected, and the pullback came with durables and non-durable goods, right? Kind of canonically, people didn't want to buy cars, and that's really where the spending reduction hit. And the fact that the spending reduction hit in these very different ways is going to be very, very important for how the shock of COVID-19 is now going to propagate through the economy. So I'm going to now look at this by looking at business revenues. And, let's just combine these kind of two facts that I've started with from consumer spending. One is that most of the pullback kind of quantitatively came from high-income households. And two, it was a pullback on in-person services. So the key thing about in-person services is that they are consumed for the most part locally, whereas durable goods are produced and all over the country. And so if you don't want to go to, let's say, your local salon to get a haircut or your local barber, right? That's going to have very, very local impacts, and that's exactly what we're going to see in the business revenue data. And so just to give you kind of a very concrete, granular look at this, what this chart does is actually shows the change in small business revenues over that first period in the pandemic by zip code in the San Francisco Bay Area. And so for those of you who know San Francisco, what you'll see is that some of the very high income areas, like the kind of Pacific Heights, right in here, or kind of in Piedmont, which is a very high income neighborhood in Oakland, in Berkeley, what you see is that the change in business revenue was much more severe, with reductions of upwards of 2/3 or even 3/4 of revenue. These are very, very hard hit areas. In lower income areas, though, so for instance, looking in South San Francisco here, looking in Oakland, looking down in Alameda and San Leandro, these are relatively lower income neighborhoods, and you see, certainly there was a very important effect of the pandemic, but this heat map, these colors are much more green or into blue, indicating that the change in small business revenue was significantly less in those lower income areas. Same thing up here in Richmond and San Pablo. And so, of course, this is just one example, but more generally, when you look across the country, this is exactly what we see. And so what this graph shows you, this is a binned scatter plot. So what I'm doing is I'm grouping all the different zip codes in the country here by the median 2-bedroom rent. So why is that something that you want to use? Well, what we found is it actually captures two very important features that are essentially a summary statistic for the local impact of COVID-19. One is whether it's a high or low income area, and the other is how dense of a population it is. And so what you want to think about is over here where there are very high rent levels, these are dense, high income places where the decline in small business revenue is on average about 50%. And then in contrast, these places over here, which tend to be lower income, more rural, less dense areas, still there was a very important impact of the pandemic, but the reductions in small business revenue are more on the order of 25 or 30%, as opposed to the 50% that we see on the other side of this graph. Now, this is what happened in April. Fast forward now another 3 months as we see spending rise back up again. How is that affecting small business revenues? Well, that's what you'll see in this gold-yellow series here. And I think what's really striking is there's an asymmetry in the initial impact of the recession relative to the recovery. And in particular, what you see is these very dense, high-income urban places over here. They had a much larger initial shock from the recession because it was all those higher-income households locally that were not going out and spending on in-person services. But the recovery over the first 3 months is actually roughly the same as it was in these lower rent, those are lower income, more rural areas. And so what that leaves you is by the time you get to the summer of 2020, these areas over here on the left have essentially entirely recovered back to their pre-pandemic level of small business revenues, whereas the higher income, more urban areas on the right here are still 20% below baseline. And of course, you ask then, like, what is driving this reduction? It's entirely being driven by things like food and accommodation and in-person retail trade. If you look at how small business revenues in a sector like finance and professional services, that's not only much less affected in a level sense, but it's much less affected by these local conditions than are food and accommodation, right? Because that's not something you really, you need to go out and do in person. So far, we have high-income consumers primarily pulling back on their in-person spending in services. That's having a very localized effect on small business revenues. And so then that's going to feed into employment as those small businesses end up laying off workers. And what we see here, first just to show you a benchmarking of this employment series, we've combined a couple different companies, and we produce the series which is in green. That benchmarks pretty well to here against the CPS, some of the gold standard series that are produced by the Bureau of Labor Statistics. Now, of course, if all I wanted to do was analyze this at the national monthly level, we could have used the CPS or the CES. One of the values in these data are the ability to look in a much more granular way. And so to get a sense of, how that works, what I've now done in this chart is I've plotted, fast forward a couple months. We're now looking at the third quarter of 2020. And I'm looking at the level of employment relative to the baseline across the top 100 counties in the U.S. We have the kind of gold standard measure from the BLS, which is the QCEW on the horizontal axis. And then we have what our economic tracker measure is on the vertical axis. And what you see is that, again, we're not getting it perfect here. And in particular, we seem to be under predicting employment for some of the very high employment places. But what we do pick out is very important variation that's within state and even within metro area. So just to give you an example, think about the New York metro area, right? New York County, which is Manhattan, is a very, very hard-hit county in the recession. And kind of both the QCEW and our data are picking this up as a very, very hard-hit county. Kind of moving out on Long Island, you first get to Queens. Queens was still very hard hit, but less hard hit than Manhattan. You then move out, kind of the next county out is Nassau County, which is, you kind of see back here. That was kind of a median county. And then all the way at the end of Long Island is Suffolk County out here, which in both data sets is a relatively lower hit county. And so I think this just gives you an example of some of the highly local variation that's being picked out in both of these data sets, and hopefully gives you some confidence that these data are a reliable measure of what's going on. So what do we learn from how these small business revenue declines end up affecting employees? Well, using our national series, we're going to split the employment changes by the wage quartile of employees. And so you get a very stark picture, what I'm showing you here. So up here in green at the top, these are employees that are earning annualized more than about $60,000 a year. They're the higher wage employees in our sample. There's a very significant effect of the recession, right? In April 2020, about a 13% decline, right? That's about 4 million jobs that disappeared. But what you see is that those jobs come back very quickly, such that by the time you get to the beginning of the summer in 2020, the recession is essentially over for high-income workers. And then even when you get into 2021, we see employment start to rise quite quickly. At the timing of this is when kind of a lot of the restrictions are lifting in March 2021. Everyone's getting vaccinated. Stimulus checks are going out. Employment is rising quite quickly in the top income quartile. The picture for the bottom income quartile, these are workers earning less than about $13 an hour, is very, very different. The initial shock of the recession is about 3 times larger. Nearly 40% of jobs go missing in the Great Recession initially. And while there is a very sharp recovery over the first few months, again, we have this asymmetry where this sharp recovery is not much larger in a way that would get back to baseline. We're still about 20% below baseline as of summer 2020. And then, to be honest, over the next year or so, things essentially don't change. If anything, they get a little bit worse. This is what some have called the K-shaped recession, where this is really exacerbated income inequality in the labor market. What's, I think, additionally shocking here is that the one story for why there's such weak employment recovery, especially over the first year of the pandemic among lower income jobs, is just that maybe all these workers are located in very hard hit sectors like food and accommodations. But even when you look in sectors that were doing much better, we still see this divergence. So for instance, let me focus here on the retail trade sector. This green line here is consumer spending in the retail trade sector. We see here what we saw before, where there's, this is the initial spike where everybody's stocking up on groceries and other stuff. Then there's a small dip in April and May. And then we return to this kind of baseline level that's about 10% above that really persists throughout the first rest of 2020, and then spending increases again following some of the stimulus payments. So the retail trade sector overall was really doing okay. How did that translate into employment in that sector? Well, comparing the green line for high wage employment and the purple line for low wage employment in the retail trade sector, you get essentially the same picture that we saw nationally. We see kind of a very sharp V-shaped recession and then recovery for high wage workers. We see an extremely sharp recession followed by a quick but partial recovery, and then kind of flatlining at about 20% below baseline, even in this retail trade sector where there's a lot more spending. And so kind of it goes beyond just the fact that are people spending in the sector? I think it starts to get to a lot about how flexible workers are, and whether low-wage workers are able to, is business activity reorganizing in a way that's, especially in these early days, relying much less on low-wage labor. So in the interest of time, let me skip this, and I just want to go forward to think about, use my last, 5 or 10 minutes here before the questions to give you this example of how I think we can not only use data like this to understand what happened in the Great Recession, in the COVID-19 recession, we can use it to help shape policy in a way that I think really isn't possible even with the traditional statistics. And so the example that I'm going to give you is trying to understand the effect of the stimulus payments. So just to recall, there was the CARES Act in April 2020, which handed out $1,200 checks to most people, right? It phased out at higher incomes. There was a bunch of details. Those checks more or less went out on April 15th, 2020. Then there was a second stimulus package passed in December 2020 that offered $600 checks. They were also phased out at higher incomes, and again, kind of with a bunch of details. Those checks became available for spending in individuals' bank accounts on either January 4th or January 6th, 2021. And so now put yourself in January 2021. We've had these 2 rounds of stimulus. And the key question is, what are we going to do now? Are we going to have a third round of stimulus? If so, who are we going to give it to? What we want to know to make that policy judgment is, were these stimulus payments effective in increasing consumer spending? And if so, for whom? That's the question we want to try to answer. And we're going to try to do this kind of as soon as we can after these stimulus payments go out. So using the Affinity Solutions consumer spending data, we can put together essentially event study charts that look like this. So first focusing on low-income households, what you see is that spending in December was kind of bouncing along about at baseline, right? There's some kind of seasonality here. We then actually omit, just for the sake of the graph, because there's some extreme variance around the holidays. And then you figure out, well, right when the stimulus checks were deposited, on that very day, spending suddenly spikes by 30 percentage points. And then it's 25 percentage points higher the next day. And then, for about the next 2 weeks, spending is on average about 8 percentage points higher than it was in the baseline. And so you really see on a daily level the immediate effect of these stimulus checks on consumer spending. But the picture that you get for low-income households in green here on the left is very different than what you get for high-income households in orange on the right. Here, things look pretty similar in the pre-period. There are some elevated levels of spending, right on the first 2 days. But after that, spending returns very sharply to almost exactly the same that it was before. And so, you can translate then these proportional changes in spending into dollars. How many dollars were these households spending? Well, kind of just to standardize things over the first month, we calculate that these low-income households over here were spending about $126 out of the $600 that they received, whereas high-income households were spending quite a bit less, only $45 out of the $600 that they received. Now, this is not only different than each other, it's also very different than what you get if you do the same analysis for the first round of stimulus that were paid out in April 2020. And so if you do the same thing, here are the green bars, what you get is that, first of all households were spending a larger share of their stimulus money in April, but also there's just much less difference across the groups. All groups seem to be spending about the same $200 out of each 600 to scale it. So that would be, in the end, 400 out of the $1,200 that they got. So we're seeing the same policy, right, is having differential effects, not only across different groups, but that heterogeneity is actually changing over time. So why is that happening? Well, I think, going back and looking at the context, what we think is going on is that, especially for those high-income consumers, remember what we've seen. Their spending was severely depressed in 2020, and their employment returned to baseline very quickly. As a result of that, they accrued a lot more savings additionally beyond what they would have had previously. And in fact, even at a national level, national savings was higher in the second half of 2020 than it's been in decades. And there was, quite a bit of money going out to low-income households as well, but they did not end up kind of saving that additional amount. And so you think about, suppose you're a high-income household, you've already got an extra $10,000 or $15,000 that are accruing in your bank account that you're not choosing to spend, making that $10,600 as opposed to $10,000. If you weren't going to spend the first $10,000, you're probably not going to spend the next $600 either. And so, that leads to the conclusion that, while low-income households did seem to be spending their money, high-income households were just saving it. The stimulus was not really reaching the economy in any meaningful way. So this analysis or various parts of it, we were actually, because of the real-time nature of these data, we were able to get this out into the public domain at the end of January 2021 as the consideration of the third potential stimulus was underway. And who knows exactly what caused what, but if we think about we have the January 2021 stimulus package that happened on top. Then what was proposed at that time for the March 2021 stimulus is on the bottom here. Our data, this analysis suggests that kind of what's shaded in green here is not really going to have that much effect on the economy. And in particular, that's like $200 billion that is a fiscal cost to the government that projects to only increase actual spending by about $15 billion. And so the policy that was actually implemented in the end actually lopped off this area in yellow. They kept the stimulus checks at $1,400 in the proposal up through the $150,000 cutoff, but they phased out the stimulus at the top much, much more quickly. And so in the end, that reallocated about $20 billion to other stuff in a way that I think was supported by these data. And I think are a nice example of, again, how you can learn about policies in real time. We can actually try to not just make policy and then hope, many months or years later we'll figure out whether it worked. We can actually try things, see if they're working, see for whom they're working, and respond in real time. And so this is just one example, but because these data are publicly available, there are many other analyses of COVID-19 policies, and some people have studied the unemployment insurance expansions, people have studied the PPP, people have studied the eviction moratoria, all in an attempt to understand, in closer to real time, how these things are working. So in the interest of time, let me stop now. Happy to talk about kind of where we think the economy is now or other aspects of this analysis, and hoping to stick around for a little bit of the informal networking after this as well. So thank you again. This has just been a pleasure to talk, and I'm excited to hear your questions.
Great. Thanks, John. It's a really interesting presentation. So my name is Ryan Goodstein. I'm an economist here at the FDIC, and I'm going to jump on to moderate the Q&A session. Before we dive in, let me just remind you that if you'd like to ask a question, you can either type it into the Q&A box, and I can read it out loud for you. Or if you prefer to ask your question verbally, you can raise your hand, and we can call on you, and we'll unmute you so you can ask the question. So I'd say while we're waiting for people to raise their hands, let me go ahead and ask you a question from the Q&A, Dr. Friedman. This one's from Keith Ernst. It says, it seems like the story of unemployment among the bottom quartile workers could be a shift in employer needs, but could also be a shift away from traditional employment to gig economy, independent contractor arrangements. Could you speak to this? Does your data shed light on this at all?
Yeah, thanks, Keith. That's a great question. So these data per se do not include like gig economy employment, just because in some sense, like the whole point of the gig economy is that people are not going to be, at least as of yet, they're not kind of W-2 payroll workers. They're independent contractors. And so we're not able to directly capture those effects here. We have benchmarked what we're doing against data sets like, as I showed you, the CPS, where because that's a consumer side survey, that does capture gig work. And so my sense is that the gig work is kind of important from a national perspective, but it is not quantitatively large enough at this point in order to shift, large amounts of employment across, in or out of the labor force. And so my sense is, maybe that's kind of 1 or 2% here or there, but that's not going to account, for instance, for the 20% reduction in low-income employment that we're seeing in the data. And I think, what is going on, my sense is that for about the first year of the pandemic, it was really a labor demand problem. Firms were not demanding, especially low-wage labor, both because of sectors that were affected, but also even within sector. Like the retail trade example that I gave, there was a lot of demand for workers at Amazon warehouses. There was less demand for workers in kind of brick and mortar retail trade. And I think we just kind of weren't able to transition, kind of get people from working in one to working in the other very quickly. For the last year, though, my sense is that labor demand really across the board has really surged. So, for instance, I didn't show this to you, but we also have data on job postings as a measure of vacancies, and the ratio of vacancies to unemployed workers is, I think, literally at an all-time high at the moment. And so my sense is the last year really is more explained by labor supply rather than labor demand. And we're happy to talk about that if you want, but gives you a sense.
Okay, great. I see another question in the Q&A box. This is from Nicole Scott. And looks like this question is referring to the small business revenue versus the rent charts. And the question is, have you looked at or considered factors such as, low-income earners and high-rent areas, and how would that affect these charts?
Yeah, so that's a great question, and I think what we've looked at is there's actually a really neat linkage where you can even trace, and kind of we went from consumer spending to small business revenue to employment. We can even take it a step further and talk about how the reduction in low-income employment especially actually boomerangs back to, you can see it in consumer spending in some low-income areas and not other low-income areas. And so, for instance, certain neighborhoods, we only measure this at the neighborhood level, where we don't have individual measures of income. But if you think that certain neighborhoods have low-income workers that largely work also in low-income neighborhoods, other low-income neighborhoods have a lot of workers that commute to work in high-income areas. And you can actually tell these apart using the LODES data from the census that come out of the LEHD, which are a mapping between work location and home residence. And what you find is, as you would expect, the low-income workers who commute to work in higher-income areas, they were the ones that are really bearing the brunt of that reduction in low-wage employment. And then you can see their spending is actually falling off quite a bit as well. Whereas the low-income workers that are working in low-income areas, their employment seems still affected, but is somewhat more stable, and it recovers a bit more quickly. Spending for those workers is actually much stronger throughout the pandemic. So it's a great point.
Thanks. And let's see, I think we have time for one more question, and then maybe we can move over to the networking break and follow up with some more discussion. This is from Barbara Van Kerkhove. Apologies if I got that wrong. The question is, she's curious as to how these job postings and vacancies vary by income level. So maybe if you could speak to that.
Yeah. So the way we've characterized the job postings is the most reliable measure we found is the skill level that's on the job posting. Obviously that's going to correlate very highly with the wage level. We found that because wages bounce around, that the exact wage level wasn't always included on the postings and was less reliable a measure. What you find is that especially in the last year, the surge in job postings has essentially been exactly proportional to the deficit in employment that we've seen. So among low-wage workers, these are low or lower skilled jobs. That's where we've seen the largest spike in job postings. For higher wage workers, where employment had returned to baseline, if not above, pretty quickly, we see much less of a spike in postings. They're still a little bit higher in, say, the second half of 2021 than they were in summer 2020. But primarily the place where employers are looking for jobs, the place where there are a lot of vacancies, are in these low-wage, lower-skilled jobs. And I think it's that combination that seems to point to a labor supply as opposed to a labor demand issue in terms of explaining the current, still about 3 million jobs below the pre-pandemic level. And so, that's what I think has led people to think about policies like, has the unemployment insurance, had some effect? My sense there is not really. Have people kind of changed their preferences, or people reevaluating coming from the pandemic? There are a lot of different theories around what's happening in a way that I actually think is still a really crucial open question. Thank you.
Great. Well, thank you so much. Let me wrap up this session by thanking Dr. Friedman again for a really wonderful presentation.
Your moderator for the first panel today. Today we'll be discussing mortgage market frictions. As a reminder, there will be 18 minutes per paper presentation, 14 minutes for a discussant, and then the remaining time for audience Q&A. As far as Q&A goes, if you can just type your questions in the chat as they occur to you, or raise your hand whenever you want. We'll keep an eye on things and we'll make sure we get to you. Without further ado, I'm going to hand over to James Vickery to talk about forbearance during the CARES Act.
Hello?
Yes, James, we can hear you.
Okay, great.
Okay. All right. Well, so thanks a lot to the organizers of the FDIC for putting this paper on the program. It's great to be part of this. So this is joint work with Yusuk Kim and Tess Shalman, who are at the Federal Reserve Board, and Dong-Hoon Lee, who's at the New York Fed. And so, I'll give the usual sort of disclaimer before I start. These are our views, not those of the Federal Reserve. All right. So a little motivation. Financial intermediaries are sort of often critical for implementing public policy. And some examples of that are, emergency lending programs, like the PPP program that was implemented during the pandemic, debt relief programs, and sort of a topical one, financial sanctions. And there's, many good reasons why financial intermediaries are used for implementing policy. But at the same time, there's sort of like, the risk that sort of misaligned incentives or other frictions might prevent policies from being implemented sort of as intended on the ground. So what we're going to do in this paper is sort of study the role of a particular type of intermediary, namely mortgage services, for implementing a large mortgage forbearance program that was part of the CARES Act. So we're interested in a couple of different things. So first of all, sort of, did services matter for sort of the rollout of this program? There's systematic differences across services. How large are they? Are they really like servicer effects rather than sort of omitted borrower characteristics? And then sort of secondly, how do liquidity constraints and other economic forces shape servicer behavior? So, what's actually driving the variation in outcomes across services that we observe in the data? And then sort of, the final part of the paper, we're basically kind of going to use this sort of variation in servicer outcomes to try and pass out, the effects, use that as a source of variation in the availability of forbearance for borrowers, and basically kind of use that to try and shed some light on what the consequences are of easier access to forbearance for borrowers as part of this program. So just to give you a preview of the key findings, we find, quite significant variation across services in forbearance outcomes. So the part of the mortgage market that we're going to look at, essentially there's sort of, effectively universal eligibility for forbearance. Really, any borrower in this government part of the market, which is what we're going to study, could apply for and receive a forbearance or was eligible to do so. But that said, there's a significant, despite that, there's a significant number of borrowers who became past due, stopped making their payments during the pandemic, but didn't enter into forbearance. And the fraction of those sort of missing delinquencies ranges from less than 10% to more than 60% across different services. So quite significant cross-service variation in outcomes. When you look at sort of across different services, large services and services that, based on some proxies appear to be less liquidity constrained, were more likely to provide forbearance. So that includes like depository institutions were more likely to provide forbearance than non-banks. And within the non-bank population, non-banks with sort of high buffers of cash, of liquid assets, were more likely to provide forbearance. And finally, we're going to sort of look at, what are the consequences for borrowers for a sort of assignment to a borrower as sort of a high forbearance servicer. And basically we show that this sort of increase in forbearance for these services translates essentially 1-for-1 into a higher non-payment rate. So in other words, sort of easier access to forbearance increases borrower liquidity during this period. And then we sort of use data from credit reports to sort of trace through what are the effects of that on other parts of the household's balance sheet. And we find that part of that increase in liquidity was used to pay down credit card debt, at least for the subset of households that are relatively less credit constrained. Okay, so a little bit of background on the Act and this program. So the CARES Act was passed in March 2020. It required services to offer up to 12 months forbearance on federally backed mortgages. So that was 12 months initially, and then this was later extended. So the direct coverage of the Act is what's called the agency market. So these are basically mortgages with a sort of government-backed credit guarantee from Fannie or Freddie or from one of the government agencies in this space, particularly the FHA and the VA. So to qualify for forbearance, the borrower basically had to attest that they had a hardship related to the pandemic. So hardship in this context is defined in a pretty broad way. And, sort of critically, the borrower didn't have to provide any kind of documentation about the hardship. They basically just had to assert that they had one. So in that sense, eligibility for forbearance, really anyone in this part of the market who wanted a forbearance really could in principle should be able to obtain one. And while in forbearance, the borrower basically wasn't subject to any penalties or fees, delinquency wasn't reported to the credit bureaus, and it also wasn't the basis for sort of the start of foreclosure proceeding. So this is kind of the basic parameters of the program. Although there was basically effectively universal eligibility, forbearance wasn't automatic. The borrower had to request and obtain it from the servicer. So just pausing your payments wasn't enough. You actually had to enter into a forbearance plan. And I'll give some anecdotal evidence shortly, but there's quite a bit of variation across services and the kinds of practices they used in implementing this program. Some services were sort of very proactive, reached out to borrowers, in one case every day, made it very easy for borrowers to apply, putting a button on their website that was kind of very straightforward. But there are other cases where services were difficult to contact, provided misleading or confusing advice, or had sort of a cumbersome application process. And finally, this was kind of a pretty large program. At the peak in June 2020, about 8.6% of all mortgages were in some kind of forbearance. Some descriptive statistics. So you can sort of see this as basically plots the forbearance rate and the non-payment rate over time. You can see here that forbearance is, looking at the left-hand panel, forbearance is very rare prior to the passage of the CARES Act, and then rises very sharply in the subsequent months. You can see the forbearance rate and also the non-payment rate, particularly elevated for the FHA market. So these are loans with insurance from the Federal Housing Administration, and these tend to be loans to borrowers that are relatively lower income, have lower creditworthiness. To give a sense of some of the kinds of issues that people had, here are some anecdotes that are taken from the CFPB complaints database. I won't kind of read through them, I won't quote them directly, but just the first two of these are basically examples of situations of borrowers who were sort of either trying to arrange a forbearance or had questions and were basically just unable to contact their servicer in a timely way. And the third and fourth of these are situations where the borrower had contact with the servicer, but the servicer provided misleading or sort of incorrect information. Okay, so for the sort of substantive part of our analysis, what's our sample? So we're basically going to look at FHA and VA loans, Federal Housing Administration and Veterans Affairs loans securitized into Ginnie Mae mortgage-backed securities. About 70% of the sample is FHA loans. Why do we focus on this part of the market? So as I mentioned already, FHA serves low-income borrowers and has the highest forbearance rate of any part of the market during this episode. FHA loans also present an elevated amount of liquidity risk for the servicer. So what does that mean? So basically what it means is that when a borrower pauses their mortgage payments, either goes into forbearance or just becomes delinquent, the servicer is temporarily responsible for forwarding mortgage payments to investors, to tax authorities, and to other parties. So there's basically liquidity risk from the perspective of the servicer. And that liquidity risk is greater in the FHA market, so that the servicer is required to forward those payments for a longer period of time and also faces some out-of-pocket costs when a loan goes into foreclosure. Okay, so the data, we're going to match basically a variety of different data sources, loan level data on characteristics and performance of Ginnie Mae mortgages from EMBS, forbearance records from Ginnie Mae, characteristics of services taken from bank and non-bank call reports, data on complaints lodged with the CFPB, and then finally the CRISM data set. And the CRISM is basically loan level, so like a mortgage level data set matched with borrower credit records. So that allows us to kind of explore the effects of forbearance on other dimensions of the household's balance sheet. All right, so the first thing we're going to do is sort of look at sort of just variation of forbearance outcomes across services. So we're going to basically run a regression of the following form. We're going to look at the subset of loans that I say non-payment here. These are basically loans that became past due relative to their scheduled payments at some point during the pandemic in the course of 2020. We're focusing on 2020. And then we basically look to see whether, did that loan enter into a forbearance? That's kind of the dependent variable. So, in principle, anyone who became past due during this period really was eligible for forbearance and also would have benefited from forbearance. But that said, there's a significant subset of these borrowers who didn't enter into a forbearance plan, and conditional on this sort of like a vector of loan and borrower controls. There's quite a bit of variation across services in the extent to which that occurred. So this is basically plotting. These graphs here are basically plotting these servicer fixed effects, and you can see here if you look to these are weighted by servicing volumes. You can see here that at the 10th percentile of the distribution, only about 10% of the people who missed out on getting into a forbearance plan, but that rises to 40% of the 90th percentile of the distribution. So there's quite a bit of variation. When you condition on sort of more serious non-payment, so basically being at least 2 payments past the scheduled past the payment schedule, the likelihood that you don't have a forbearance plan is significantly lower, which is good. So that basically is saying that the people who are really having trouble making their payments were more likely to get into a forbearance plan. But you can still see that there's very significant variation across services. So what's driving that, right? So this could reflect variation in servicing practices, but it could also reflect admitted borrower characteristics that affect forbearance demand. So it's in some senses the supply or the demand for forbearance that's at play here. And so we sort of talk about this quite a bit in the paper, and we sort of argue that admitted borrower characteristics are unlikely to be the explanation for that sort of wide histogram that I showed you on the previous slide. So first of all, if you look at the sort of construct kind of a balance table and look at the characteristics of the loans serviced by high versus low forbearance services, they basically look quite similar. And then, in addition, when we can basically sort of use delinquency pre-COVID as sort of an it's like a reveal preference sort of measure of borrower credit risk, right? So we basically look to see whether flows in delinquency are systematically different for borrowers assigned to these different types of services. And we basically don't find any evidence that that's the case. And then finally, these estimates of the fixed effects are quite insensitive to the set of borrower controls used. So unobservable characteristics, like adding these additional characteristics, really doesn't move the needle in terms of measuring these servicer effects. So the next thing we then do is we then say, okay, well, what are the drivers of these variations in outcomes? And so we're basically doing this by matching the MBS data to bank and non-bank call reports, and then we basically estimate a regression where we estimate these servicer fixed effects as a function of servicer characteristics. So this is what comes out of that. So let me highlight a couple of things about this. So the first of all is that organizational form seems to matter. So non-banks are significantly less likely to offer forbearance than depository institutions. Conversely, credit unions are actually more likely to offer forbearance to a borrower that was past due. And then second, size matters. So, it wasn't kind of obvious to us ex ante whether a large servicer would be more or less nimble or more or less borrower friendly in this case, but it's pretty clear in the data whether you measure size by servicing assets or the log of the assets on the servicer's balance sheet, that larger services were able to get a relatively higher fraction of their non-performing borrowers into a forbearance plan. And then the third thing I would highlight here is liquidity. So basically, if you look among the non-bank population, the non-banks are basically more exposed to liquidity risk because they rely on short-term wholesale warehouse credit. Among the non-bank population, services with high cash buffers at the start of the pandemic were significantly more likely to offer forbearance. So these are borrowers that were, arguably maybe more resilient with respect to these kind of liquidity outflows associated with forwarding payments to investors. And one thing that we think is quite notable is you don't see the same pattern for banks, right? So banks have access to backstop sources of liquidity through the Federal Home Loan Bank system and through the discount window, and we're also, enjoyed some significant liquidity inflows through the deposits in the early stages of the pandemic. So we think it kind of makes sense that this is kind of tied to non-banks. Sorry, did someone say something?
4 minutes, James.
4 minutes. Okay. All right. Great. Okay, so I'll just quickly mention a couple of additional results related to this that we sort of present in the paper. We show that these sort of low forbearance services also have a sort of higher rate of consumer complaints against them. So we basically match this data up to sort of complaints lodged with the Consumer Financial Protection Bureau, and you basically find services that were less likely to offer forbearance have a higher fraction of forbearance-related complaints against them. So this is kind of consistent with, we think this kind of also fits together that, this set of services, had like relatively less borrower-friendly practices. And then, in addition, we sort of look at heterogeneity. So we basically sort of see, well, is, the effect of assignment to a high forbearance servicer, does it have differential effects depending on the type of borrower that you are? And we basically find that, high forbearance services sort of move the needle in terms of getting people into forbearance, more so for groups that were less likely to enter forbearance. For example, borrowers with a low outstanding mortgage balance. One exception for that is that they don't seem to have been successful for low credit score borrowers. Okay, so then the last part of the paper, we're then going to sort of basically try and use this sort of variation, variation across services to try and say something about the effect of forbearance availability on borrower outcomes. And so we're basically, to do this, we're basically using a match between this EMBS records and forbearance records and CRISM. And CRISM basically has, so we basically able to use the loan level records in CRISM to match to EMBS, and then basically able to use the fact that CRISM also has this information from the borrower's credit report on non-mortgage debt balances, an updated credit score, and things like that. And then we basically estimate a model of models of this kind of form. We're basically looking at some outcome variable as a function of whether the borrower was assigned to a high forbearance servicer, and then we basically interact that with a bunch of time dummies. So we basically effectively trace out the dynamics of, how the outcome variable varies over time as a function of which servicer you were assigned to, and then, conditioning on a sort of a set of borrower characteristics. All right, so let me show you how some of that looks. So first of all, let's look at sort of forbearance and non-payment. So kind of almost mechanically, assignment to a high forbearance servicer increases the likelihood that you're going to end up in forbearance. But what's not mechanical is the fact that leads effectively one-for-one into an increase in the non-payment rate. So basically, it's not the case that they just took borrowers who'd stopped paying and got them into forbearance. They actually increased the set of borrowers who paused their payments. So in other words, easier access to forbearance, basically provided liquidity to borrowers. And has basically no net effect on the frequency of non-payment outside of forbearance, which is basically this blue line here in this event study plot. Then when we turn to some other balances, we find that basically part of this additional liquidity seems to have been used to pay down credit card debt, but that's concentrated in the subset of borrowers with relatively low credit card utilization. So we sort of split the sample sort of high, above versus below median in terms of credit card utilization, and the borrowers that have low utilization, that arguably less credit constrained, use this money to sort of reduce their credit card balances. The borrowers that were maybe more constrained, that you don't see any effect. So that would be, we can't see exactly how they use the money, but it'll be consistent with the idea that they use the money more for consumption rather than to pay down other sources of debt. Some other outcomes we look at, we find that high forbearance, so, one concern about forbearance availability is that there were some borrowers who basically ended forbearance, continued making their payments, and then were unable to refinance for a few months. And so that would potentially one negative consequence of entering forbearance. We don't find that any evidence of that among this population of borrowers who became past due. So basically, if you became past due, you have to reperform anyway for a few months before you can refinance. So this kind of makes sense. And we also find little net effect on the borrower's credit score, right? And so why is that? So being in forbearance, for a given borrower, if you're not paying, getting into forbearance is good for your credit score, right? But then that's offset by the fact that the number of people who are in this non-payment state increases. And so on net, there's basically a little effect on average borrower credit scores, although there's effects on individuals. All right, so to sum up, we find intermediaries matter in this, in the CARES Act forbearance rollout. I mean, this is a program where, a lot of steps were taken to make this very streamlined, and I think it's clearly relative to the debt relief programs put in place after the Great Recession. This is a much more streamlined program, but it's still the case intermediaries still matter, even in this situation. Interestingly, access to liquidity matters here, and interestingly, this was not obvious to us a priori. Large services, sort of display sort of more borrower-friendly behavior for this particular program. And then, we find that easier forbearance, access to forbearance, improved borrowers' cash position, and part of that money was used to pay down credit card debt. From sort of policy implication, so thinking about whenever you see this sort of variation across services, you kind of wonder whether, could some sort of prior planning or auto enrollment reduce these cross-servicer disparities? I think that's the one policy consideration. Our results highlight sort of the importance of non-bank liquidity provision. So this is kind of an ongoing policy debate about, the liquidity risk facing the non-bank mortgage company sector. Here we're providing some evidence of that liquidity risk is affecting behavior in the product market by these firms. But we sort of end by just highlighting, we think that this program, clearly, provided debt relief in a much more streamlined and sort of like successful way in some sense than the programs implemented after the mortgage crisis and the Great Recession. Thanks.
All right. Well, I'm not sure where to start.
Peter, you are all set to start.
All right. Well, thanks. I'm sorry.
Sorry. Okay, we have next with us is Vivek Bhattacharya, and he's going to be telling us about information frictions in the mortgage refinancing market.
All right. Well, thanks a lot for the invitation and for putting the paper on the program. This is joint work with Ignacio Cuesta, Gaston Yanes, Ana Maria Montoya, Remigio Draga, and Gabby Covarrubias, and it's a fantastic team to work with. This paper is, let's see if this works. All right, here we go. So this paper is fundamentally about understanding market power in banking, how effective simple treatments are in alleviating it, and what the implications of doing so are. Broadly, we think of market power is derived from things like search costs or switching costs or some sort of differentiation across banks. And in this audience, of course, it probably doesn't come as any surprise to hear that behavioral frictions or informational frictions can fall into one of these buckets. So borrowers might not know how to search for mortgages at banks. They might be unaware of how much they can save if they search for mortgages at banks, search for refinancing, and they might even be unaware of the possibility of refinancing itself. So in this project, we're going to partner with a large Chilean bank, Banco Estado, and we'll send emails to nearly all of their mortgage holders. Each email is designed to target one potential behavioral friction. Okay. And here we're going to ask two simple questions. The first one is, does such a light touch intervention have any impact on whether borrowers search for refinancing at all? And if so, what sort of impact? So that's the question we'll focus on today in this talk. Our second question is about the equilibrium impacts of such an intervention. If they are successful in affecting how how the borrowers search and in alleviating the frictions we mentioned above, then how would banks respond? And that part is still work in progress, and we're excited to hear anything you guys have to say about that. Chile is a particularly interesting setting to study mortgage refinancing, and this graph essentially shows you why. So over the past decade, interest rates have been falling pretty precipitously. So to see this, you can look at the grad distribution in light blue. That's the distribution of interest rates for mortgages that were originated in 2010. In dark blue, you see the distribution for mortgages originated in 2019, and you see that there's almost no overlap. And so if you look at a mortgage that's outstanding today and compute the savings that this guy would get if they refinance, then you get an average gain of around $4,000. In US dollars. And there's a big long distribution, long tail. Despite all of that, only about 6% of more originations are due to refinancing. Refinancing is pretty rare. So what are we going to do here? we're going to run the experiment, and so this is essentially the set of results we're going to talk about today. As I mentioned, search for mortgages is pretty low, but we find that this simple email can have a large impact on it, even doubling or sometimes even tripling the rate of search. Of course, search is the binary thing. Another observation we have is that interventions affect what we might call the nature of search, who searches and how they search. In particular, we find that it generally increases the sensitivity of search to savings. It also increases the relative propensity of borrowers to search at their home bank, and this has implications for bank pricing, which we'll mention at the end of the talk. We are able to conduct a few surveys. So our third finding is that the survey evidence suggests that this mechanism operates through beliefs. These interventions do actually adjust the beliefs that people have about savings. And finally, so these first 3 points are essentially things we can read off the surveys and read off the experimental results. One thing the experiment can't teach us is how banks would respond if this treatment were made permanent. Okay? And so that's the question we're working on right now through the lens of a model of pricing. All I'll say today is that essentially anything that goes into that model of pricing is affected. So we think that understanding that this fourth point is also an interesting question. So we have 3 main sources of data. From our partner bank, Banco Estado, we see a lot of information on how clients search. So we see a lot of information about the clients themselves, but we also see how they search. The reason we see this is because in late 2020, Chile implemented a law called portability that was designed to make it easier for customers to move between banks. Okay. Essentially, a side effect of that law is that if I suppose walked into Santander and asked and was interested in a mortgage, Santander would send a request to Banco Estado to get information from me. Banco Estado, if Banco Estado is my home bank. And Banco Estado records all these requests, and we see that. So essentially, we see a measure of search. We see whether customers are going to different banks to search. We also see whether customers are asking for Banco Estado products internally, if they're far enough along the process. We can merge this to administrative data from the regulator, from the Financial Markets Commission. And here we see all outstanding mortgages in Chile, their terms, their performance. So essentially, we see whether customers were, not only do we see whether they searched, we see whether they were successful in getting a new mortgage. And finally, we run a few surveys, both before the treatment, during treatment, and after treatment, and ask questions that we don't see in other places in the data, like why did you not refinance? What do you think you would get if you refinance? Things like that. Okay. So this is a timeline of the experiment. I won't go into too much detail here. Essentially, we have 250,000 clients. That's a very large subset of the mortgage holders in Banco Estado, and we randomized them into 1 of 5 treatments in the control. The treatment was sent out in July 2021. That's the dotted line in the middle. And we were able to conduct some surveys that I mentioned before at baseline and after the treatment was sent out. We stratify based on demographics, in addition to whether people completed the initial survey or not. Okay. So here are the treatments. So before I go into exactly what they target and what they look like, and what they target and what the behavioral friction we're trying to target is, I just want to spend a couple minutes or maybe a minute just talking about what they look like and how they were delivered. So this all happened through email. The email came from Banco Estado. It didn't come from Northwestern or Stanford or the University of Chile or something. It came from Banco Estado. The subject line was something like important information about your mortgage. Okay. What you see here is essentially a screenshot of the PDF file that was attached to the email. The PDF file was password protected, essentially with the Chilean equivalent of the last 4 digits of your social security number. That's a standard file protection in Chile for financial documents. And we tried to make it look as official as possible. So it had this treatment was designed in conjunction with CERNAC, who is the Consumer Protection Agency in Chile. And so it came stamped with CERNAC's logo as well. So this is the basic treatment that we have, what we call awareness. So at the top of this treatment, you see, and apologies for the Spanish, the top of the treatment, you see some information about the mortgage itself. Okay, so this is monthly payments, how much, what the principal is left, how many payments you have left, things like that, interest rate, things like that. Okay. This is information that Chileans are used to getting every quarter about their mortgages. At the bottom of the page, or the bottom of the second half of the left part of the page, you see the treatment itself. So this is very simple. What it says is information about refinancing mortgages. Okay, and essentially it says, did you know you could refinance your mortgage and potentially reduce your monthly payment? Okay. That's it. It doesn't give you any information about how to do that or what that means. It just tells you that you could save money. So we think of this as essentially an awareness treatment. It's just making people aware that this is possible. Our second treatment goes into a bit more detail about what you could actually save. So you see the exact same information as in the first treatment, but you also see this thermometer of where your current interest rate is. That's 4.7% in this diagram, and our prediction of what you would get if you refinanced based on data from CMF on the universal mortgages in Chile. So in this case, that's 2.9%. We put this in a sort of pleasing graphical format. To sort of, in this case, it makes the point that you're paying a large interest rate, 4.7%. You could be paying a lower interest rate, 2.9%. We also compute annual and total savings, and we report them as well. Okay. The third treatment is search, or things we think of as targeting search. So loosely, we think that some of the search costs could come from psychological factors like an inability to compare rates across firms. It could also come from the fact that customers aren't even sure what to do or how to compare rates across firms, or how to even go about searching for firms, searching in banks. So we try to tackle both those frictions in this treatment. So off to the right, you see essentially a primer on how to compare rates. Okay, what fees are, how to compute sort of monthly payments, things like that. On the second page of this treatment, you see a step-by-step list of things you have to do to search for the mortgages of banks. Okay, so essentially, it's trying to teach people how to search. And we think of this as maybe reducing search costs. The fourth treatment is trying to target switching costs. So this goes back to the law that I mentioned a few slides ago, the reason we have the data. Chile passed a law that made it easy for people to switch across banks, switch their financial products across banks. What this treatment does is essentially gives the customers a step-by-step of how to do that. Okay. And finally, we have one treatment that puts all of this together, exact same stuff, the things you saw on the previous slides, except over 2 pages. Okay. And of course, we have a control group. The control group doesn't get any of these letters. It doesn't get a special email from Encuestado at all. Instead, it just gets the information about their mortgage through a separate channel. Okay, so that's something that all Chileans who have mortgages get every 3 months. That's the only letter that the control group gets. Okay. So this slide shows just the main effect of treatment. Okay, so the first set of 3 dots is you can think of as the control mean. And every subsequent group of 3 dots are treatment effects. They're not the mean of treatment, it's the treatment effect itself. Okay, and these are 95% confidence intervals, and of course we control for strata fixed effects, the whole shebang. Okay. So you can see that search. So this is the probability of a particular type of search over the course of a quarter. And you can see that search is actually pretty low. Only about 0.5% of people actually engage in any search at all. You can focus on the blue dots for now. Even though search is low, the treatment effects are actually pretty large. The least treatment has an effect that's about 2/3 of the baseline mean. The search treatment has an effect that's about 1/3 of the half of the baseline mean. Switching increases effects by about 33%. Even awareness, which is just telling people, hey, you can go refinance, at 90%, it actually has the mean effect is about 15% of the baseline, and 90% this is statistically significant. So these simple treatments really do seem to have an effect. The full treatment, which is putting it all together, has an effect that's even larger than the mean. Sorry, was there a question or did I?
5 minutes, sorry.
5 minutes? Okay, thanks. All right, so if you look at search rates, then other search rates are also similar. If you look at internal search, that's much less likely, but we see a very large effect on internal search as well. Treatment effects seem to decay over 6 weeks, so this is a pretty short-lived intervention. We next look at treatment effect heterogeneity. So this is showing you the mean, so essentially the mean for different deciles of treatment, deciles of some sort of outcome or some sort of covariate. You can see that high-income individuals are more likely to search at baseline, and the beliefs in the full treatment seem to reinforce that effect. Older individuals are less likely to search. Beliefs in full treatment seem to reinforce that effect as well. So essentially, who searches seems to be effective. We can look at loan characteristics. So people who have high interest rates and therefore, or people who have a lot to save are actually more likely to search at baseline. Beliefs and full treatment seem to reinforce that as well. The reason this is a bit interesting is that the macroeconomics literature has talked about the nature of search, whether search is state dependent, whether it depends on prices and interest rates. And what we find here is that search is state dependent at baseline, but that treatments can affect essentially how state dependent it is. Certain treatments make it more state dependent, certain treatments seem to increase search across the board. From the survey evidence, we can ask how much people expect to save. People who are very optimistic about how much they expect to save tend to search more at baseline. This is heterogeneity by essentially optimism. But treatment effects are lower for them. So if people are pessimistic and they learn that they can save more, then they essentially search more as well. So this is some evidence that treatment seems to be affected by beliefs. Okay. So far we've mentioned that treatment affects the level of search, and over here you see on the first row you see the sort of mean probability of search as a function of control and different treatments, and you can see that treatment does increase search. We can also ask how the last couple of slides essentially tells you who searches, and that's affected as well. The next two slides tell you how people. This slide, the next two panels of this table on this slide tell you how people search. So panel B shows you the distribution of search, conditional on searching, as a function of treatment. And you can see that treatment increases the rate of search, but it also increases the rate of internal search relative to external search. So people are more likely to search at their home bank after treatment. And you can do Fisher exact tests and whatever, and it's statistically significant here. This is interesting because if we think about how banks are going to respond, this is going to affect the bank's pricing incentives that they're likely at retaining the customer. Panel C shows you conditional and external search, which banks do you search. The evidence is a bit weaker here, but there's some suggestive evidence that treatment affects the set of banks that are searched, and therefore that's going to affect the effective substitutability across banks. And that's going to affect pricing as well. Does this have any impact on interest rates and on actual refinancing? And this graph sort of gives away the answer. Interest rates have been declining in Chile for about 10 years. Unfortunately, when we delivered treatment, interest rates started spiking significantly. Obviously not causal, but it was just an unfortunate timing. And perhaps as a result of that, we just don't see any. We see a lot of increase in search, but this search doesn't necessarily translate into any real outcomes.
Hey, Vivek, you got 1 minute?
Yeah, thanks. So in that 1 minute, let me just wrap up and by telling you about the implications for the supply side. So the experiment doesn't tell you how banks would have adjusted their pricing. That's because we showed you that the effects are short-lived. We don't expect banks to have internalized the effects of the experiment, obviously. So we can write down a simple model of how banks respond, and banks are gonna the pricing policy of a bank is gonna be dependent on the propensity of borrowers to search in the future, the sensitivity of search to future mortgage rates. People who are familiar with pass-through analysis knows that the curvature of the demand curve is really important, and how the elasticity of demand changes with search. That's also important as well in pricing. And what we learned from the experiment is that every one of these effects every one of these factors are affected, and they're affected differently by different treatments. Okay, so we're interested in sort of quantifying that effect right now. So some quick policy implications. We find that very simple treatments, just a simple email essentially free to do, can be pretty effective at increasing search. The search rate remains low, but the treatment effects are quite large. The effect decays pretty quickly. So if you're thinking of this as an educational campaign, that's probably not the right mental model. You should think about sending in periodic reminders. We also find that gains are concentrated, that the policy has distributional impacts. The gains are concentrated on those with higher potential savings. That's probably the intention, but it's also important to remember that these guys also have high incomes and might have are different sorts of people in general, larger loan sizes. And finally, we find that how borrowers search are affected, not just their level of search, but the sort of the nature of search as well, which is interesting for by itself, helps us think about mechanisms, but it's also important because it's going to affect how banks price. And so the next steps of this project are to use this experimental variation and sort of the lens of a simple model of pricing with one-sided commitment to quantify this effect. So thanks a lot.
All right. Thank you, Vivek. I'd like to now invite Laura Lowenstein to discuss these two papers.
All right, so thank you to the conference organizers for having me or giving me the opportunity to discuss these two papers. And of course, nothing I say today reflects the official positions of the Federal Reserve Bank of Cleveland or the Federal Reserve System. So I'm going to start with the first paper on information frictions in debt relief. So what this paper does is it takes variance or variation in the rates of forbearance among delinquent borrowers among servicers to classify servicers as either high forbearance or low forbearance servicers. And so what that means is they're looking at a population of borrowers who had sort of guaranteed access to forbearance. So all of these borrowers should have been able to get forbearance. And once they are delinquent, it would have been better for those borrowers to have been in a forbearance program so that their delinquency did not affect their credit scores, et cetera. But among certain servicers, there was a high rate of borrowers that were delinquent but not in forbearance. And what they find is that what they do after they classify these servicers as either high forbearance, so very likely to have most or all of their borrowers that are delinquent in forbearance, to low forbearance servicers, is they find that forbearance rates are lower at low forbearance servicers overall, but so were delinquency rates, meaning that in some sense, these low forbearance servicers were better at finding the borrowers that sort of really needed forbearance. If we assume that that because they were not delinquent, they were able to continue making their mortgage payments, but that did come at some cost, meaning that there was this higher rate of non-forbearance among their delinquent borrowers. And that's really captured in this graph, where here we're comparing rates of forbearance and delinquency among high forbearance servicers to low forbearance servicers. So what you can see on the left-hand side is that forbearance rates among high forbearance servicers were higher overall. But if we look at rates of borrowers that are in forbearance and current, those are effectively the same at high forbearance servicers versus low forbearance servicers, meaning that there wasn't higher rates of borrowers entering forbearance and so remaining current on their loans among high forbearance servicers. And then on the right, what you see is that delinquency rates were also higher at high forbearance servicers. And this increase, as James said, is effectively one-to-one with this increase in forbearance rates. So what was happening is that high forbearance servicers were getting borrowers that were entering forbearance and subsequently not paying their mortgage because they were now in a forbearance program. Whereas the low forbearance servicers were effectively not selecting those borrowers to enter into forbearance. And then here we see effectively what we were seeing in distribution on the previous slide, where we're seeing the rate of delinquent borrowers that are not in forbearance. And then you see a much smaller difference between the two different servicer types, with the significant difference only occurring in the first few months of the pandemic. And actually, this is something I'm wondering if the authors can use to sort of get a better understanding of why there is this difference in access to forbearance among servicers. So my main comments is that I think these findings are really interesting for two reasons. Like, the first is that the forbearance was a really unique program, at least in our recent history. It certainly differed substantially from our reaction to high mortgage debt in the Great Recession, in the sense that it was a program that was fully concentrated on payment relief and not on principal reduction or anything along those lines. It also in some sense, aligned incentives between servicers or mortgage lenders and mortgage borrowers, in the sense that if you are in forbearance, you have an incentive to eventually continue making your mortgage payments and to maintain your house, because the house is still yours, right? So what I am concerned about, or not necessarily concerned about, but what I don't take away from this paper is any evidence that mortgage servicers were acting in any sort of nefarious way, or that they were weren't acting in a way to benefit borrowers. Because while there was this variation in servicers, because forbearance was such an unprecedented program, there could be other reasons that mortgage servicers were different in their in how they extended that forbearance to borrowers. So, for example, non-bank mortgage companies or smaller non-bank mortgage companies with fewer assets may just have smaller administrative capacity. So they may not, even if they have the skills to put a button on their website, they may not have the back-end capacity to manage that button, so they won't put that button up at all. And I don't see anything currently in this paper that sort of tells me whether it was that was the reason why there was this variation across servicers, or whether it was that these sort of more credit-constrained servicers were trying to avoid providing forbearance so that they wouldn't have to advance payments on the part of borrowers. And I do think there's a few things authors could do to sort of maybe tease out what was driving this difference in behavior. One being is there changes in forbearance rates among delinquent borrowers over time. So as I mentioned in the previous slide, there was this lower forbearance rate among delinquent borrowers early in the pandemic, but at that point, there was a huge increase in uptake in forbearance. And so maybe if that dissipates over time, that implies that once the sort of inflow to forbearance declined, the smaller non-bank mortgage companies were able to sort of catch up, in the sense that they were able to sort of manage the flow of borrowers requesting forbearance later on in the pandemic. And then you could also sort of tease out some of these differences in forbearance exit activity. The authors do some of that, but I think they could probably do more with a longer time series, and then also potentially look at evidence in terms of foreclosure activity once the foreclosure moratorium ends. And then my second comment was just that I think it would be interesting to look at what point servicers might seek forbearance. So currently, the authors look at borrowers that are 30 plus days delinquent and then 60 plus days delinquent, and the distribution in terms of borrowers that are not in forbearance that are 60 plus days delinquent is much narrower than those that are 30 plus days delinquent. And I would like to see the distribution for 90 plus days delinquent. Maybe at that point, servicers are really servicers really want the borrower to be in forbearance, because in some sense that is better for them than because they can't initiate a foreclosure and during the period when there's a foreclosure moratorium. Okay, so moving on to the second paper on information frictions and mortgage refinancing. I thought this was a really interesting paper and definitely highlighted some of the behavioral issues in terms of people refinancing. And what effectively this paper did was it was a field experiment in Chile where they sent letters to a bunch of mortgage borrowers, effectively just providing them with some information, like here's how you refinance, here's how much you could save if you refinance, et cetera. And they sent different letters to different people, and then looked to see what happened, because they have some really unique data on how people search for refinances. I think this was really interesting from a behavioral finance perspective. Unfortunately, there was, of course, this increase in interest rates after their intervention that resulted in them not being able to see any actual change in refinancing activity. But I think that nonetheless, the results are very interesting. My comments here are a little more narrow. So my first comment is just and I apologize for the sort of US-centric nature of some of these comments, that I could do with a few more institutional details on Chile's mortgage market. So, for example, the paper discusses that most mortgages in Chile have prepayment penalties, but there's no discussion of closing costs. At least in the US, those can be substantial. So if, for example, you think you're going to move in the next few years, you may not want to refinance, even if you have sort of large savings over the life of the loan, because you'd have to pay those upfront closing costs, and therefore that's not worth it. A much smaller point is that in the US also people can buy up or down their rate using points, and there's no discussion there. In Chile, I don't think that's an issue, but it would be nice to just know, like, is there a similar, are points also used in Chile? Are they not used, etc. I'm also wondering whether the authors can do any additional breakdowns by borrower demographics. For example, there's been some interesting work done related to the U.S. mortgage market on refinancing activity differences across race, where they find that minority borrowers are much less likely to refinance. Finding something similar in the Chilean market would be of interest potentially. And then I just wanted to sort of point out that the authors estimate these effects on the probability of searching for a new rate using both an OLS and an IV regression specification, where in IV they IV using whether the person opens and reads the email that includes the letter. I just wanted to point out that those two actually should bound the true effect in some sense, with probably more emphasis put on the OLS point estimate. But if you think the OLS estimate is in any way biased downwards, maybe because of some sort of measurement error, then those two should bound the true effect. And so that should give you a little, I thought that might be useful to the authors in some sense. And then lastly, I guess my concern with the policy prescriptions is, yes, I agree that possibly just reminding people to refinance or look into refinancing regularly might be much better than sort of like some sort of educational campaign. And that happens as like a one-off thing. But one thing that does worry me about this specific intervention is, given that interest rates increase so much, and given the sort of lag between when they measured the potential gains to refinancing for borrowers versus when borrowers were actually looking for rates to actively refinance, that if they repeat this kind of intervention, borrowers' trust in the sort of how much this letter is implying that they will save is going to decrease, especially since it's not real time. So I'm wondering if that may sort of change what the policy prescriptions are. And that concludes my comments. So thank you so much.
Thank you, Laura. I just want to take a moment now if Vivek and James want to give their response to Laura's discussion. Maybe James should go first since he went first.
Sure, yeah. So thanks, Lara, for the very thoughtful comments. Yeah, I think there's maybe some more things we can do to. I certainly think that, like, the fact that we find large services were sort of like relatively more likely to offer forbearance. I think it's an interesting fact. I think you could offer a number of different interpretations that would be consistent with that, and it would be nice for us to be able to, pass those a little bit more. I think this kind of like these facts about liquidity that, like cash balances matter for non-banks but not for banks. I think it's kind of consistent with the story that liquidity constraints played a role here. I mean, we don't, this is not perfectly well identified in the sense that, we don't have this sort of exogenous variation in liquidity across these different non-banks. It's certainly possible that there are some omitted characteristics that we're not controlling for that sort of come into play there. So I think there's some more things we could do. And I think, these sort of suggestions about looking, just kind of looking at more serious delinquency instead of seeing, do these things converge, and looking at timing matters as well. I think in terms of the timing, really, like, as the sort of entries into forbearance are very, concentrated over a fairly narrow window of time. So basically most people who come in, who are seeking forbearance were seeking it in the spring of 2020. And so there isn't like that much scope for catch up, really, because that's really most of the action happens over that sort of relatively short window. But I think there's a lot of good suggestions. So thanks very much for your comments.
And before Vivek jumps in, let me just say that please take this opportunity to type any questions or raise your hand if you want to ask it in person. And then, okay, Vivek.
Yeah, thanks a lot, Laura, for the excellent comment. So just a few quick things. We should have been clear about this in the paper, but the points thing that you see in the U.S. isn't a thing in Chile. Closing costs, I guess, are important. Those aren't. I don't think we we incorporate that into our analysis. There's a prepayment penalty of 1 month, approximately 1 month. I think it's 1 month of your mortgage. That is actually taken into account in the final savings. So we show them the interest rate, and then we subtract off the or estimate of the prepayment penalty from the total savings. But we should certainly be clear about that in the paper, and also that there are other costs to refinancing that we need to be clear about. And so that's useful. OLS and IBS bounds, that's also very useful. I agree with everything which are shown in the presentation was OLS. I agree that I share your intuition that that's probably the thing that's closer to the true treatment effect, because who knows, the guys who didn't open the email, who knows what their treatment effect is going to be. But I think of them as bounds is very interesting. And the last point is the policy point. I think that's a really nice point as well. Ideally, from the Chilean government is actually thinking about implementing this as a full-time policy. Ideally, when it sort of happens, the prediction is going to be a bit more real time. So hopefully in the future, the government would make the predictions and send out the emails pretty quickly. This time there's a lot more red tape involved in getting approval from the bank and things like that. And hopefully it didn't have any long-term sort of cost to the policy, but I agree that making sure that this information is real time is important. Yeah, thanks a lot.
All right, let me go ahead and take a question from the audience, and this question is directed to James. Is the servicer's mix of FHA and versus VA loans relevant in the difference between servicers, or is it similar across servicers? Can you provide some idea on the composition there?
Yeah, so there is quite a bit of variation. If you look across mortgage services, there's quite a bit of variation in the kinds of loans that they service, and their relative concentration in the FHA market. And it's certainly the case that only a subset of services, service FHA at all. We didn't look at. I don't think we've looked directly, and it's certainly not in the regressions in the paper, as to whether that mix shows up in terms of affecting their forbearance propensity. When you look at complaints, complaints are higher for services that have a higher fraction of FHA loans that they service, which is probably just a reflection of the fact that FHA loans, it's like relatively, lower income, more at-risk borrowers, and so you could imagine there could be just more issues relating to those loans. But this is certainly something we could definitely do. We should take a look at it. So thanks.
Okay, and I see Keith Ernst has his hand up.
Thanks. Sorry, it took me a second to get off mute there. This is another question on the first paper for James. You talk about this in terms of liquidity, but I wonder, is there a possibility that what you might be picking up is a little bit of a supervision effect? There's a lot of overlap between those categories, but if you think about it in terms of, you may have bank lenders who clearly are sort of directly supervised. You may have large FHA lenders, which are, or servicers who are, more closely monitored for their activity. And then you may have a third class that doesn't fall in either of those two buckets, if that's something you have or could look at in this paper.
Yeah, so I certainly think that the, this relationship with size, certainly within the bank population, I think, like a very plausible explanation. And I think a plausible explanation for the difference between banks and non-banks, regulation is kind of like, I think, a fairly plausible, culprit there in some sense. Within the non-bank universe, non-banks are much less tightly regulated than banks. It may still be the case that, for example, they are subject to sort of, supervisory oversight from the CFPB, and it may well be that the CFPB is kind of like, keeping, sort of like a closer watch on the large services, and that could contribute to their behavior. So I think that, this sort of like size relationship that we find, I think, regulatory sort of the intensity of regulatory oversight, I think, is one explanation for it. It would be nice for us to dig into this a little bit more. We don't have, we don't have that many banks. Like, so for example, if we really had like every bank represented, I mean, I guess we could expand the analysis to consider GSE loans as well, and then we'd just have like a larger number of services. But you can imagine doing things that people have done, sort of like analyzing the effects of stress tests, for example, where you kind of like break the sample up into, banks that are subject to stress tests or banks that are, relative to different regulatory thresholds, basically. But we don't really have enough institutions in our sample to kind of do that with any power, unfortunately. But yeah, so I think that regulatory channel, I think it's very plausible that's part of the story.
Hello, everyone, and thank you for joining us for this panel on alternatives to bank credit. I'm Mary Zacny, I'm an economist at the FDIC. Just like in the first panel, we've set aside some time at the end for Q&A. So as you come up with questions, please either enter them in the Q&A function, or you can raise your hand and I'll call on you at the end. We'll first start with Emily Gallagher from the University of Colorado Boulder, and she'll be talking to us about the financial implications of plasma sales for individuals and non-bank lenders. Thanks, Emily. Go ahead.
Hi, thank you for having me. So this is joint work with John Dooley at Washington University in St. Louis. And at a high level, this paper is about the ability to sell your plasma for money and what that does in terms of demand for payday and installment loans, as well as consumption in the local area. So you're probably wondering what plasma is. Plasma is a component of blood. It includes lots of good things, but most notably antibodies and clotting factors. It can be formed into pharmaceuticals to treat immune deficiencies, hemophilia, and other diseases. Actually, plasma-derived medications are completely vital for people who have immune deficiencies. Plasma has become a growing form of discretionary income in the U.S., so pharmaceutical companies will pay donors $50 per donation during normal times. During the pandemic, this actually doubled or even quadrupled in some places due to shortages. The FDA allows people to donate plasma 2 times per week, so up to 104 times per year you could potentially donate plasma. So in normal times, you can think of donating, if you donate 8 times per month, getting $400 in compensation. Plasma is fairly accessible, so you just have to be in good health to donate. This is different from other forms of discretionary income, so gig labor sources that have popped up in recent years, where often you need to have particular skills, like particular crafting skills to sell something on Etsy, or physical capital, like a car, to ride for a rideshare program. We estimate that about 2 to 3% of the U.S. donated plasma in 2019. That's actually more than used payday loans, auto title loans, rent to own, and pawn loans. So this is a I just pulled a typical sort of advertisement. This is from CSL Plasma, which is one of the major corporations. And you can see they really market themselves in terms of the financial benefits of donating plasma. The compensation is loaded onto a reloadable prepaid card. So you could also imagine a lot of people are potentially entering the prepaid card market through plasma donation. CSL is one of the bigger plasma corporations, but there are a number of them, including Grifols, BioLife, Octapharma, BPL. These are sort of the big guys. It's a very concentrated industry, so the top 4 pharmaceutical corporations are operating about 85% of the centers. And if you notice this, these corporations are typically headquartered in other countries, so Australia, Spain, Japan, China, and so forth. And so these international pharmaceutical companies are drawing most of their source plasma from the United States. And the reason they do that is because the U.S. has fairly liberal laws around compensating donors. So most countries do not allow for this kind of remuneration for donating plasma. The U.S. is one of the few countries that does. And so as a result, there's really been this sort of exponential growth of plasma centers in the U.S. in recent years. In the last decade, we estimate that the number of plasma centers has more than tripled. Today, we think there are over 1,000 locations. Plasma is actually a major U.S. export, which was sort of stunning to me. It's 2% of U.S. exports. It's actually the 8th largest U.S. export category. We estimate that something like 3.7 million adults in the U.S., so just 0.06% of the world's population, is currently providing 64% of the world's plasma. There are a couple other countries that allow for plasma compensation. These are Germany, Austria, Hungary, and Czechoslovakia. Only those 4 countries and the United States are currently able to meet their own domestic plasma needs. All other countries, for the most part, Canada, UK, they have to import plasma from countries that permit compensation. Without the compensation, it's proven very difficult to generate enough plasma to meet the needs of citizens. So with this proliferation, you can see where plasma centers have opened across the country. So you can see them opening, for example, across the U.S. The blue dots are the more recent openings. The red dots, yellow dots, these are sort of, they've been around for 5-10 years. You can see these openings occurring on the U.S.-Mexico border. In our study of where plasma centers tend to open, we found that earlier on in the century, they tended to open in dense urban areas, so the low-income neighborhoods and cities. And in recent years, we've noticed this movement out to the suburbs. So they're moving to more economically diverse areas in suburban areas. Actually, when I first became interested in this topic, it was from observing a plasma center in Ferguson, Missouri. Ferguson, Missouri is sort of outside, a suburb just outside of St. Louis. It's a low to middle income kind of suburb. And also in our research, we've noticed that these plasma centers do tend to open in areas that have more non-traditional bank credit. So in terms of the motivation for this paper, first off, there's kind of been a lack of household finance research on the ability to sell one's own biological materials. So there have been some studies of organ donation, but really all of the work that exists in this area has been really focused on market structure, not on the individual financial effects of being able to do this. We actually don't even have descriptive information on the characteristics and motives of plasma donors. There has been a growing literature in recent years on gig work and how it's affecting consumer welfare. But this work has been really focused on rideshare programs, and rideshare is it's the type of consumer who engages in rideshare is quite different from plasma donors, as I'll discuss a little bit more in a minute. But basically, to drive for Uber, you have to have a fair amount of physical capital. You tend to be financially better off than the typical plasma donor. Plasma donation is much more universally accessible. There have also been studies of substitutes for payday loans. We kind of thinking about how plasma is interacting with payday loans, but the existing literature on this is also quite focused on how payday loans are interacting with bank overdrafts. There is one other paper that's looking at income shocks and how that affects payday loan usage. That's Vetling and Shu. They look at a minimum wage hike and show that after a minimum wage hike, there's less payday loan usage in survey responses. Now, it might seem kind of obvious that if you give people access to income, they might need less high interest debt. But theoretically, the prediction here is actually a bit ambiguous. So first off, there's a cash flow mismatch. So think about it. When you're selling your plasma, you can get $50 per donation up to twice per week versus a typical payday loan, which would be like on average about $400. And so to sell plasma in order to avoid needing a payday loan in the future, that actually requires a lot of foresight, a lot of planning. And it's not actually that clear from the literature that households are able to maintain precautionary savings, particularly on the low income side. And then finally, you could imagine that households might actually become more likely to use high interest debt because they know if need be, they have this source to pay it down. So If you aren't rolling over the payday loan, you're not going to hit those astronomical APRs. So with cheaper financing, the need for precautionary savings could decline. So in the end, we think this is kind of an empirical question that we're going to explore. So what do we do? What are our exact questions? First off, just descriptively, we want to know who sells plasma, why they sell it. Then we want to turn to how being able to sell your plasma is affecting your demand for non-bank credit. And then finally, we're interested in sort of how this might be affecting people's ability to smooth consumption over time. We're going to look at consumption in the local area. Now, there's an important limitation here, which is that we do not observe health outcomes. In delving deeply into this topic, something that really surprised me is there's not a lot of very convincing medical research on what selling your plasma at this frequency over a long period of time might do. And so you could imagine scenarios where outside of our study window, so we're only following people for 4 years, outside of that, maybe some health outcomes could occur. We don't know. And if that happens, you could imagine that affecting people's ability to earn income and then potentially offsetting any sort of financial benefits we uncover in this paper. So we're not going to be able to take any sort of position on whether plasma donation is good or bad for overall consumer welfare. We're sort of limited in our scope. Okay, so going into this project, first thing I noticed is there's really no questions about plasma donation just have not been asked in a lot of surveys, specifically surveys that are also linked to information about your broader financial well-being. And so we started our own. Basically, we added some questions to an existing survey that goes out to online tax filers who qualify to file their taxes for free. So these are going to be low to middle income filers who file with a major form of online tax preparation software. We added some survey questions to that, and that's going to generate a lot of our descriptive information on plasma donors. There was a second survey implemented through Washington University in St. Louis that went out during the early stages of the pandemic. The advantage of that survey is it's more nationally representative. The disadvantage is it goes out during the early stages of the pandemic, and so it's a little bit hard to interpret how the pandemic might be affecting people's use of payday loans, of plasma, etc. Rather than show you a bunch of tables and graphs, let me just highlight what the descriptive results tell us. What are the main conclusions we draw? First thing is, back in 2018 and 2019, about 3.3% of respondents to that, these are the online tax filers, donated plasma in just the last 6 months. That's more in that survey that then took out a payday loan, auto title. It's a bit fewer than went to a pawn shop. During the pandemic period, we actually find double, triple the rates of both plasma donations and use of non-bank credit. So not sure if the pandemic is causing that or if it's just a difference in the sample. The typical donor is young. They're typically under age 35. And that kind of makes sense because in order to sell your plasma, you do have to pass a couple health checks. So for example, if you go in there with high blood pressure, they may turn you away. And if older people are therefore more likely potentially to be turned away. They tend to have no college degree, they're low income, low credit score, and they also report being underbanked. There's a ton of overlap between the characteristics of plasma donors and payday borrowers. Main difference is just that the typical payday borrower is a bit older than the typical plasma donor. And by comparison, if you compare plasma donors to other gig workers, so people who drive for Uber, work on Upwork, sell for Etsy, these other gig workers, they're financially better off. They have better credit scores. They report having access to bank credit, which makes sense because you probably need a loan to buy the car in order to drive for Uber. Actually, when we ask plasma donors, why don't you do other forms of gig work, they typically report being unable to access it for lack of this kind of physical capital. Plasma income is typically used, according to the survey responses, for essential and emergency expenses. That's 64%. Only 19% say they use it for non-essential goods. and only 6% say they use it to repay debt. So already we have a bit of a signal here that that sort of debt repayment mechanism is probably not a major source of why people sell plasma.
5 minutes.
Okay. So our main outcomes of interest in this paper are going to come from Experience Clarity Credit Bureau. So they're going to show us payday and installment usage. And then also we want to look at consumption. We are going to proxy for consumption using SafeGraph data. SafeGraph aggregates cell phone tracking data. And so we're going to look at foot traffic to nearby establishments. Our identification strategy in this paper is going to rely on there being variation in a person's ability to sell their plasma. And this variation can come from being located near a plasma center that opens. So in order to be certified by the Plasma Trade Association, centers have to draw from their local area. So if a plasma center opens near you, that is a major shock to your ability to sell plasma. In order to get these openings, we have to cobble together a bunch of different resources. My co-author, John, did an amazing job here. He even looked at Google satellite imagery of parking lots to figure out when these centers actually opened. He was able to get the opening dates of 95% of centers that opened in the 2014 to 2021 period. And so we're going to do a stacked difference in difference. Essentially, we're going to allow the locations of where plasma centers open to be non-random, but we are going to have this assumption that the exact timing of when they open is quasi-random. And so we're going to use a stacked diff and diff, and basically we're going to form cohorts where treatment is the 5-kilometer area around a new plasma center opening, and the controls are going to be the 5 people in the 5-kilometer area around a nearby plasma center that opened either in the distant past or will open in the future. That's the basic idea here. And so here's one of the main results. So here we're looking at payday and installment loan inquiries, and you can see after a plasma center opens that they tend to drop. And this effect is driven entirely by the under age 35 group. So for these people, access to a plasma center reduces their payday and installment loan inquiries by 13 to 16%, so a pretty substantial effect. And to put that into perspective, actually, let me move on to transactions and I'll put that into perspective. So loan transactions also are affected similarly. So it's not just inquiries. Inquiries might be a measure of demand. Transactions are also affected. So they drop for the under 35 group by 18%. And so to put that in perspective, an 18% drop in payday transactions after a plasma center opens is quite similar to a result in that Detling and Shu paper about minimum wage, where they find that a $1 minimum wage hike leads to a 16% drop in payday loan usage in survey data. So we're basically just having a plasma center open near you appears to be a similar effect on payday loan usage as a $1 minimum wage increase in the area. Less use of high interest debt after a plasma center opens is not necessarily welfare increasing. So we're also interested in whether people are able to consume more after a plasma center opens. And indeed, we find that's the case, at least based on visits to local establishments. We see a 7% increase in essential establishment foot traffic after opening. So here you see essential places like grocery stores and gas station. Surprisingly, we also find an increase in visits to non-essential establishments. So these are places like restaurants, entertainment venues. So even though in the survey data, people report using plasma income primarily for essential things, according to foot traffic, we're also finding it at non-essential establishments. And you might think, well, maybe these plasma centers are opening in areas that are sort of taking off economically, and that's what's driving this. When we look at natural control groups, so for example, visits to schools where you're not spending money, but should be correlated with a lot of people sort of moving into the area, we don't see any change in visits to these kind of natural controls.
30 seconds.
So let me wrap up here. Plasma donors tend to be younger, financially vulnerable, much more than other gig workers. Plasma income seems to help these kind of infrequent borrowers avoid taking out loans. We don't find a lot of evidence that they're repaying loans faster. And I didn't show you evidence of this, but it's in the paper. We're not seeing like fewer rollovers after a plasma center opens. The effects here are pretty large. So to the extent that we have fewer one-off payday borrowers and installment borrowers, that implies quite a bit in savings of financing costs. We estimate it to be about $200 million when a plasma center, in areas that receive a plasma center. There's this wide boost in local consumption as well. And so you can think of sort of a broad policy implication here. It seems that you can get pretty big local economic multipliers by having some sort of access to modest occasional supplemental income, say $50 an hour earned twice per week. And then finally, let me just reiterate again, we are not able to see the long-term outcomes if selling your plasma is affecting health, and the medical research just doesn't seem to tell us one way or the other very convincingly. The net welfare impact of these benefits that we find, they could be completely offset. We just don't know. And I'll leave it there. Thanks so much.
Thank you, Emily. Next, Dimutu Ratnadewikara from Louisiana State University will be presenting on fintech lending with alternative data.
All right. Thank you very much for including our paper in the program. This is joint work with Marco DiMaggio and Don Carmichael. In this paper, we study the use of alternative data by a fintech lender in the consumer lending space. So let me start with this particular figure based on a survey conducted by Upstart, which is the fintech lender that we study in this paper. So according to their survey, if you look at the people who had access to some sort of credit product, 80% of those people have never defaulted on any of those credit products. But if you look at the mix of credit that these people had access to, only about 48% of these people had access to bank quality credit. So this mismatch highlights that there are systemic issues in the current credit system. So one of the reasons for this mismatch is the way in which the traditional lenders evaluate the creditworthiness of the borrowers. Credit models in the consumer world are primarily based on the credit score and maybe a handful of other variables. Often there are minimum credit score thresholds. For example, if your credit score is less than 660, you will be immediately disqualified from getting a personal loan. And if your credit score is less than 620, it's very hard for you to get a mortgage. So we are not saying the credit score is a bad measure of credit worthiness. The credit score seems to work well on average. So these two figures that you see here are looking at the predictability of credit score on credit card defaults and mortgage defaults. So these are regressions where we regress the default on a bunch of dummy variables for each credit score bin. So you can see there is a very strong negative monotonic relationship between the credit score and the default behavior. However, this average relationship we saw earlier masks a lot of heterogeneity within each credit score bin, particularly in the left-hand side of the credit score distribution. So this three-digit number is not sufficient to capture the complexities in the real world. Let's take, for example, a recent graduate or a recent immigrant. These people will have a low credit score primarily due to their shorter credit history, but their actual credit worthiness is probably higher than what the credit score suggests. And also there are other issues with the credit score, like 20% of the credit reports having a verifiable error, and also if you make a mistake, it remains on your credit report for a long period of time. So that is if you have a credit score. There are about 50 million Americans who don't have a credit score at all. So for a lender who's relying on this credit score to evaluate borrowers' credit worthiness, this segment of the population is invisible. So we call them credit invisibles, and these people tend to be younger, and also lower income people and minorities are more likely to be credit invisibles. And if you go beyond the United States and look at the other developing markets, the vast majority of the populations in these countries do not have credit bureau coverage, so they don't have access to formal channels of credit. So what we've seen after the 2008 financial crisis is that several fintech lenders have emerged who tout the use of sophisticated algorithms and alternative data in their underwriting models and use online platforms to originate credit. So what we're trying to do in this paper to see whether this advent of fintech lenders have the potential to remove some of these inefficiencies in the credit markets. So specifically, the questions that we are after in this paper are whether the use of alternative data lead to broader credit access, particularly for the credit invisibles, and also whether they are able to borrow at a lower rate because of the use of these modern underwriting algorithms. And also, we want to know what kind of data is most useful when trying to identify good borrowers or invisible primes among these credit invisibles. And also, we want to know whether this is a sustainable business model, as in whether the fintech lenders are able to generate positive returns by lending to these invisible primes. And finally, we want to know what are the consequences, or whether these invisible primes benefit by having access to this type of credit, whether their financial conditions improve. So the primary challenge when trying to answer these questions is the counterfactual. So if you want to evaluate the access to credit, we need to know what would have happened had these fintech lenders not use these alternative data or modern algorithms. So that's the primary and empirical challenge. So we try to answer these questions and overcome this empirical challenge using Upstart as our empirical setting. So we got access to anonymized administrative data from Upstart. So Upstart is a major fintech lender that is listed in the NASDAQ. But Upstart is a good setting for us because Upstart is known for its use of non-traditional variables such as education, the digital footprint, and your employment history in their underwriting models. In fact, Upstart applied for a no-action letter from the CFPB, where CFPB compared Upstart's model to a traditional model and concluded that Upstart's use of these alternative variables do not lead to violation of fair lending practices, and gave the green light to go ahead with this model. So we have access to this model that CFPB used as the benchmark to evaluate the Upstart's model. So this is what we're going to use as our counterfactual to compare what would have happened had Upstart used the traditional model. So here are our main results. So presumably, Upstart used these alternative variables and identified the invisible prime. So if that is the case, the credit score should not be very informative in predicting this borrower's default. So that's what we find in the paper. The credit score is not a good predictor of default for Upstart loans. This is particularly true for in the left-hand side of the credit score distributions or for credit invisibles. And then when you look at the actual model that Upstart used to underwrite these borrowers, we find that that model is predicting default very well. It has a very high predictive power compared to the credit score. And then we use that traditional model developed by CFPB to evaluate what would have happened had Upstart used that traditional model instead of their own model. So what we find is that if you look at the left-hand side of the credit score distribution, when the credit score is less than 660, 25% of these borrowers that Upstart funded would have been denied credit had Upstart used that traditional model. So this traditional model is actually based on a logistic regression, and it has about 1,600 features that is extracted from the credit report. So it's not a very simple model. It's a sophisticated model that uses a lot of variables to predict default. So this is the effect on the extensive margin. And then if you look at the intensive margin, the interest rate, then we find these invisible primes receive a significantly lower interest rate from Upstart compared to the interest rate that they would have received had Upstart used the traditional model. And then we find these impacts are stronger for individuals with thin credit files and younger individuals and for borrowers with higher levels of education. And finally, we show that this lending to investable primes is a sustainable business, as in that the upstart is able to generate a higher IRR by lending to these investable primes. And also these invisible primes are able to improve their financial conditions when they have access to credit from upstart. Their credit card defaults go down, their credit scores improve, and they're more likely to purchase a home. So one concern here is that whether these results are unique to upstart. So we are able to replicate some of these results using publicly available mortgage data by comparing Quicken Loans, mortgages originated by Quicken Loan to the mortgages originated by few large banks. All right, so let me quickly go through our data set. So we have in our data set about 770,000 loans originated by Upstart and more than 2.3 million applications Upstart received from 2014 to 2021 first quarter. And for all of these loans and applications, we have the credit report data at the time of application. And in the case of loans, we have their subsequent performance data. In addition, we have access to most of the alternative variables that Upstart is using in their underwriting models, such as education, the digital footprint related variables, and their employment related variables. There are few key features that differentiates our data set from the data sets that we've seen in other papers. First of all, we have access to the output of Upstart's underwriting model, which is expressed as a probability of default. So this uses variables from the credit report as well as those alternative variables I just talked about, and that's based on a machine learning algorithm. And the output of this algorithm is a probability of default. And in addition, as I mentioned earlier, we have access to that traditional model. So for each loan and for each application, we have what the predicted probability of default from this traditional model as well. And finally, we have a panel of both funded and rejected applicants. So Upstart is able to pull the credit reports of disqualified applicants for up to a period of 12 months. So we are able to observe their credit reports 12 months after their application, so we can evaluate or compare the funded borrowers' financial conditions to the rejected applicants' financial conditions after 12 months. So these figures should give you a basic idea about Upstart's portfolio. So you can see the number of loans grew significantly from 2014 to 2020. In 2020, they originated about 300,000 loans, totaling up to more than $3.5 billion. And most of these loan applications to Upstart came through lending aggregators like Credit Karma, LendingTree, or NerdWallet. So it's not like a specific set of applicants who directly come to Upstart's website. So these are the people who go to these lending aggregators to compare the loan offers from different lenders. So this assuages some of the concerns regarding selection. So this is kind of more representative of the average borrower in this market. And also most of these loans are for that consolidation and credit card refinancing. So if you compare the funded borrowers to disqualified borrowers, one of the main differences in our data set is that if you look at the credit score of the funded borrowers, the average is 654. This is much lower than what we normally see from other lenders. So this suggests that Upstart is mostly concentrated on that left-hand side of the credit score distribution. And if you look at the differences in these alternative variables in the bottom of this table, so we can see that funded borrowers are more likely to be college educated, and they are less likely to be hourly workers. And also they're more likely to use a computer, and if it's a computer, it's more likely to be a Mac. And if it's a smartphone, that's more likely to be an iPhone. All right, so let's jump into the results. So in this first set of results, we are looking at the predictive power of credit score and Upstart's probability of default in predicting the actual default rate. So here we have grouped the loans, Upstart loans, into 4 categories based on the credit scores. And ordinarily, you would expect that the credit default rate to be negatively correlated with the credit score, but as indicated by these blue numbers, you don't see that negative relationship. And then if you look within each credit score bin, you can see that there is a large variation in the Upstart's probability of default. So, which suggests that in each credit score bin, Upstart is saying even though the credit score is very similar, there are some borrowers who have very low probabilities of default, and there are some borrowers who have very high probabilities of default. This is particularly important for these low credit score bins where the traditional lenders are not very active. And then on the flip side, Upstart is saying that some of these borrowers with high credit scores may be more risky than what the credit score is suggesting. And now the question is, how accurate is this Upstart's model? So as you can see by these numbers, so these are the actual realized probabilities. So you can see that relationship is positive and monotonically increasing. So this suggests that Upstart's measure of probability of default, or Upstart's a measure of creditworthiness, is doing a very good job in identifying different types of borrowers within each credit score band. So we have a more formal regression with fixed effects and control variables making the same point in the paper. But the idea here is that credit score is not a very good predictor in default within Upstart sample, but Upstart is able to identify different types of borrowers using their measure of creditworthiness. So now, what is driving these differences? What is behind the superior performance of Upstart's underwriting model? Is it because that Upstart is using these alternative data, or is it because that they are using a more sophisticated model? So we are trying to sort of disentangle these two in this next set of results. So first, we try to run a regression where we regress Upstart's probability of default on a bunch of standard variables. And then we include these alternative variables one by one as fixed effects. We are not allowed to show the coefficients, so that's why we have to increase these as fixed effects that you can see if you look at column 2, where we include education as fixed effects. The R square increases from 43% to 45%, and so on. For the column 3, we add the employment-related fixed effects, and so on. So here, to give you a sense of what the economic magnitudes are like, so let's take two borrowers with same credit score, same loan amount, and same age, but one borrower has a high school diploma and the other borrower has an advanced degree. So for this borrower with the high school diploma to get the same probability of default, according to Upstart's underwriting model, that borrower needs to increase her income by $107,000. And we can do a similar exercise with the credit score. If you take two borrowers, same age, same income, same loan amount, the one with the high school diploma needs to increase the credit score by 37 points to get the same probability of default. So this suggests that these alternative variables are having a big impact on Upstart's probability of default in terms of the economic magnitude. But still, we don't know whether the superior performance is due to the alternative data or due to the more sophisticated model. So that's here we are trying to disentangle these two by comparing the area under the curve of different models. So as we know, area under the curve is used to evaluate the predictiveness of these measures, and if it's close to 50%, then there is no predictability. It's almost random. When it increases, the predictive power of the model is higher. So the first bar here is using the credit score. You can see the AUC is just only 54%, and as you go along, using the CFPB's model, the AUC goes up to 60%, and then when we add alternative variables to the CFPB's model, we see that the AUC jumps up significantly. And then the final model here is Upstart's actual model used for underwriting, and the AUC of this model is 66. It just improves from 64 to 66. So most of this improvement in the predictive power is coming from alternative data. So finally, we want to understand what does this do to the credit access, whether this leads to broader credit access. So this is the most important figure in the paper. So here we group the applicants into 4 categories based on the outcome of the Upstart's model, the actual model they're using for underwriting, and the CFPB's model. And what you see is if you focus on this dark blue area, so these are the fraction of borrowers just approved only by the Upstart model. So you can see that about 25% of these borrowers with credit score less than 700 would have been rejected had Upstart used the traditional model. And also, if you look at just the approved borrowers, you can see we apply an underwriting model of a large bank. So most of these borrowers with credit scores less than 660 would have been rejected according to this large bank's model. And if you use the CFPB model, and that doesn't help either. So we see similar differences in the interest rate. Had Upstart used the traditional model, these low credit score borrowers would have paid a very high interest rate compared to the actual interest rate they paid.
I think our time's up.
Okay, so just to conclude, we see that use of alternative data by Upstart led to broader credit access, both in terms of in the extensive margin and the intensive margin, and also finally the result that I couldn't get to, that Upstart is actually able to generate a high IRR by lending to these invisible primes, and also these invisible primes financial health improve when they get access to credit from Upstart. Thank you.
Thanks, Dimutu. Next, Emily Williams from Harvard Business School will be discussing these 2 papers.
Is it okay if I share my slides rather than do the WebEx version?
Emily, you should be able to share your screen
Gotcha.
at this point.
Yeah.
Thanks.
Great. Wonderful. Well, thank you so much for inviting me to discuss these absolutely fascinating papers. I could not be more thrilled to discuss each of these papers. I find them both absolutely fascinating. So the first paper is Blood Money. As we heard from Emily, the authors kind of start with this motivating and pretty startling fact that in the United States, households donate plasma for compensation at a higher rate than they use things like payday loans, auto title loans, or pawn loans. And additionally, we know that the numbers around this, around 2 to 3% of people in 2019 donated plasma, and even more so during COVID-19. And this is because for a 90-minute visit to the plasma center, up to twice a week, you can earn around $30 to $70 per donation. So if you did that, twice a week, every week of the year, then you could earn quite a substantial amount of discretionary income. And the authors also sort of present some really fascinating facts that the income earned from plasma donations are used for things like day-to-day expenses the majority of the time, and also for sort of non-essential discretionary spending. So in this paper, at a very broad level, the authors are asking, well, what's the effect of selling biological resources on financial outcomes? And as Emily mentioned, we really don't know very much about this. And so this is kind of one of the first papers that we have in this space. And then more specifically, we can think about it sort of as, how does discretionary income impact demand for payday borrowing for the financially constrained population? And as the authors note in their paper, the effects ex ante are not exactly clear. On the one hand, you can have this increase in discretionary income. That means you can repay your costly debts faster. This essentially reduces the actual borrowing costs that you're paying. We all know from the literature that this then might have a precautionary savings motive, where we have a decreased precautionary savings motive because we have cheaper access to credit. And then so we might save less and then actually borrow more during, say, financial emergencies. On the other hand, we might have more discretionary income. We might save more. We might then have less reliance on debt and less reliance on borrowing during financial emergencies. And finally, you might think of another scenario where you have increased income. This means you increase consumption because you're kind of present biased, or you suffer from other behavioral biases, and there's no impact on borrowing during financial emergencies. And so, as Emily pointed out, really, this is an empirical question, and this paper aims to contribute to this space, trying to understand how does discretionary income impact things like demand for high-cost debt. So I'm going to run through the main findings in a number of charts. So as Emily showed us, one of the main findings is that we have inquiries for alternative credit go down, specifically for younger people. So the main thing to look at here is the orange dots. They go down relative to the green dots. Inquiries are often thought of as a proxy for demand for credit. So the more inquiries are, the more demand there is. And so this shows that there is a decline in demand. We also see on top of this, that actual payday borrowing declines, again, for the younger population. And we also see, conditional then on having a payday loan, that there's actually no evidence that repayment is faster. Additionally, the final important thing that we see is that there is evidence of this higher consumption. And I am just presenting here one of the charts, but they all look the same for all different types of establishments. This is foot traffic data, which is a really cool way to try to get at measuring, consumption. So it's a really creative way of trying to get at that part of the research question. So we see quite a substantial increase in foot traffic at most establishments, for example, entertainment. So what are the policy implications of all of this? So for one, this paper sheds light on who the people are that use things like options like donating plasma. So I think one of the important things that we learned from this paper is that the people who are donating plasma are also likely people who are, for example, borrowing via payday lenders. And it's important to understand the complete set of alternatives that each person faces. Why? Because, well, then we can really understand, the full set of choices that they're going to make, and this can really help to direct policy. Additionally, I think something important from this paper is that the authors are documenting a pretty large multiplier effects. And of course, I think it's important for policymakers to try to understand the drivers of this multiplier effect. So just to be clear, the multiplier effect is that we see a much larger consumption response relative to what we would expect from the declines in payday borrowing. So comments and suggestions. My first comment is, of course, and the authors address this, they're very upfront about this. The consumption response seems pretty large. And so one of my suggestions is, can you do a little bit more to kind of rule out that plasma centers are kind of locating in these in these areas that are experiencing this hyperlocal economic growth? So really clever idea to look at the daycares and the schools foot traffic as a control. But one thing I think about this when I read that was that there might be capacity issues at these establishments. That means you won't necessarily see an increase there. And so I wonder if you can, for example, use maybe an additional set of data like info group and just check that these plasma center openings are not correlated with things like other establishments opening, or kind of getting some other sense of whether or not that they're correlated with general hyperlocal economic growth within these like very, very local areas. And then also kind of related to this point, when you do your kind of payday borrowing tests, can you possibly use your treatment and control within the same really granular geographical area? But your treatment group will be the young borrowers, who are the people that are much more likely to donate plasma, and the control would be the older borrowers. And it's really cool that you can see the age of the borrowers. And the benefit here is that you can include that really granular geographic times time fixed effect. So that's going to absorb any of those time varying local factors. And if you find similar results, then I think that would really help the reader that it's really not these other, hyperlocal economic growth effects that are kind of driving these results. More broadly, again, it's hard to know, of course, what channels the increased consumption and reduced demand for borrowing are working through. I think it's kind of important to know because the policy response could possibly be different. So, for example, if people are kind of donating their plasma to prevent getting to move away from payday borrowing and that prevents debt traps, then, you know, I think that's definitely something to think about. Whereas if they're just, you know, donating plasma because they really want to consume more, then that's, you know, I think that there'll be much different policy responses if we can kind of try to understand what channel is at work here. But of course it's hard, data is really hard, but absolutely fascinating paper. So moving on to the second paper, again, super interesting paper. So the motivation for this one is that credit markets have been significantly disrupted by fintech in recent years, as we know. And a key feature of fintech lenders is that they're substituting this sort of in-person contact between the lender and the borrower for algorithms and, you know, really cool models, machine learning and alternative data. And of course, there is an active, ongoing, for a very, very long time, policy discussions focused around opening up credit markets for the millions and millions of US consumers who are basically shut out of credit markets in the United States. So in this paper, at a very broad level, how do fintech intermediaries affect credit availability and household financial health? At a much more specific level, how does the use of alternative data and algorithmic underwriting impact credit availability? And the authors are able to attack this question because they have access to an amazing set of data. So they have Upstart's own proprietary probability of default. They have rejected applicants as well as funded applicants, and they also have the traditional model, which is a great counterfactual. So they have counterfactuals all over the place, like actual counterfactuals. So it's a really, really, really cool set of data. Just to kind of run you through the key findings in a set of images. Hopefully this will help them stick. So the key findings are that credit score does a good job of predicting default in general. So you see this relationship, this kind of, you know, the higher your credit score, the lower the probability of default. However, for some people, credit score does not paint an accurate picture. So the crucial thing to look at here is you get this flat region here for the low credit score people. These are for loans that were extended by borrowers that were serviced by Upstart. So these are Upstart borrowers. And for these people, credit score does not do a good job of predicting future credit worthiness. So there's something there, right? And indeed, the Upstart credit model does a much better job of predicting future credit worthiness. So we see in these Upstart default probability bins, we see this very positive monotonic relationship here. So another key finding, this graph, alternative data variables are the main drivers of improved performance. So really what we're seeing here is that when you move from the traditional model here to the traditional model plus alternative data, you see this massive increase in area under the curve. And then you see a little bit of an increase here for the Upstart model, which is working on the alternative data. So really the big difference here is coming from using this alternative data. And again, then using alternative data is expanding credit access to exactly the people who would otherwise have been denied, particularly people with thin credit files, and increasing access to credit for these people has some real effects that the authors document. So what are the policy implications? Well, of course, it's important for the debate on the use of alternative data in screening for borrowers. And this paper clearly shows that current methods are possibly excluding millions of people who can be extended credit profitably and sensibly. So the paper shows that, you know, adding new data can have real impact. And of course, the authors note that we need to take this further. We need to study more to understand if using these new variables is going to have any discriminatory bias. So my suggestions, I only have a few. This is an incredibly thorough paper, really covered so many bases. So I have a few minor suggestions. One of them is that, you know, your setting doesn't have a normal recession or normal bad times. And so is there a scenario under which, you know, the Upstart alternative data model can't survive a negative shock? And I'm not suggesting that you go crazy and do any analysis here, but I'm wondering if there could be a little bit of a discussion around that, maybe a couple of sentences. And I'm wondering if you have a sense of if this is true or not. So the next suggestion is that we see, in that chart that I just showed you, we see differences in area under the curve for traditional data plus traditional model, expanded data plus traditional model, and then expanded set of data plus new model. And I really want to see also what's the area under the curve for the traditional data plus the new model. So what we're seeing here, what the authors have documented is essentially D minus C minus A, but what I want to see is D minus B minus C minus A. And I think that we can really learn something about whether or not it's the model driving it or the data driving it by looking at these differences or these tables. So just one more additional point there. And then also, finally, people who are disqualified look different along observables. Not a problem for your empirical work because you do entropy matching. But this, of course, highlights a new question, which is what can we do for these people? Is Upstart's method the best we can do? Is there money left on the table? These people likely have much higher marginal utility, so there's possibly massive welfare gains there. I'm wondering, I'm not suggesting for this paper, but this is possibly another paper. Of course, so much to study in this space, but do we have a sense of any heterogeneity within credit scores for this specific group? So just to wrap up, both papers, super interesting, really cool, shed light on segments of the US population who are, typically really hard to study, and they give us some new insights. So after reading both papers, I think we know a little bit more about how the financially excluded households, cope, how they borrow, how they get some extra income, and also how we might improve their ability to cope through, extending them credit profitably. And I'm really excited to see how these papers progress.
Thank you, Emily. We have around 5 minutes left. We could, if people want to ask questions, please raise your hands, or you can write a question in the Q&A, and I'll read it out loud. But I'll give a chance to Emily and Demutu to respond to what Emily has anything that Emily has brought up. We could start with Emily Gallagher and then go to Demutu.
Yes, thank you so much, Emily Williams, for that discussion. This is a new paper, so getting that kind of feedback is incredibly helpful. You are completely correct. The consumption response is larger than we would expect. One thing we are thinking about is the timing of it happening during the pandemic, when plasma compensation rates were much, much higher, reaching as high as $200 per donation. So we're wondering if that's sort of driving it. Really, really like your idea of using the older people as sort of a control to get around some of these identification issues. Just absolutely fantastic. So thank you very much. I'll leave it there.
Hi, Emily. Yeah, thank you very much for the wonderful discussion. About your comment on the economic downturn. So we had the COVID, and so that you probably can't call that a normal. So we have some analysis, but which we haven't included in the paper yet. What we find is that Upstart's default didn't increase as much when you compare to the other personal loans. So, so that's something that we've done some work on. And regarding your other suggestion, I think that's a very useful suggestion to use Upstart's model just on the traditional data. Thank you.
Okay. Are there any questions for our two speakers? If you have them, please raise your hand. And also, we'll have time after this panel. You can ask the presenters face-to-face questions in the networking sessions right after this panel. Okay, I have a question here from Elisa Yoro. Is Upstart lending to those who don't have a credit score? Looks like most of the loans were for credit card debt or debt consolidations. This loan purpose doesn't fit with the motivation of expanding credit access. Could we think of this as repricing credit more than expanding credit access?
So Upstart doesn't lend to anybody with a credit score less than 600. So we think that our estimates are kind of underestimate the actual impact. So This is the segment, if you focus on the segment between 600 and 660. So this is, in this segment, no bank with a traditional, no traditional bank will lend to you and offer you a personal loan. So in this case, we see that it's actually expanding access to particularly the left-hand side of the credit score distribution rather than a reallocation from banks to fintechs.
Okay, well, thank you to all the panelists here.
Okay, good afternoon. Thank you for joining us for Panel 3 on student loans. I am Jeffrey Weinstein, an economist in the FDIC Center for Financial Research, and will be moderating this session. We have set aside time at the end of the panel for Q&A. At any time during the panel, you may use the raise hand function feature or type a question in the Q&A text box. If you use the raise hand feature, I will be able to call on you and unmute your microphone so that you can ask the question directly. Or if you are unable to do so, or you do not want to ask your question verbally, then feel free to use the Q&A text box, and I will read the question out loud, time permitting. And you also have the opportunity to chat with the speakers in the virtual reception immediately after the panel. So to begin, Paulina Medina from Texas A&M will present her paper, Student Loans and the CARD Act Campus Ban. Paulina, you have 18 minutes, and I'll let you know when you have 5 minutes and 1 minute remaining.
Thank you, Jeffrey, and good afternoon, everyone. And thanks to the organizers for including our paper in the program. This is joint work with Alex Brown, who is a colleague at Texas A&M, and Daniel Grodzicki at the OCC. The usual disclaimer applies. The views here do not necessarily reflect those of the OCC, the Department of Treasury, or the United States. All right, so the big picture motivation of our paper is to look at policy evaluation in a comprehensive way. Policy evaluation is at the heart of empirical microeconomics, but more often than not, the evaluation of a program focuses on the effect of that program on the intended market without looking at potential effect of that same program on other markets. So with that in mind, we study the consequences of limiting access to credit cards for college students on two of the largest markets for non-housing debt in the U.S., the credit card market and the student loan market. The regulation that we study is a particular provision of the CARD Act, and we find that this landmark consumer protection regulation in the credit card market had an impact in the student loan market. Specifically, we find a significant increase in demand for student loans that is concentrated in students that come from less affluent backgrounds. What we think is a comprehensive look at the evidence suggests that this policy redirected students that were the most susceptible to make financial mistakes towards cheaper credit and ultimately led to improvements in academic performance, specifically in terms of GPAs and on-time graduation rates. So let me start by providing some context about the CARD Act and this provision known as the campus ban. As you all probably know, the CARD Act was put in place to protect consumers from deceptive practices by credit card providers, but in particular, Title III set up provisions to protect young borrowers. There's a provision of particular interest for us, which is referred to as the campus ban, that limits the marketing of credit cards within 1,000 feet of a college campus. So the first thing to note is that the campus ban is not a ban on students. It does not ban students from getting a credit card. It is actually a ban on credit card issuers. It bans credit card issuers from marketing their products on campus. So from the perspective of a student, we can think of the campus ban as a nudge away from credit cards. And what we're going to do is that we're going to show that this nudge actually has an impact on student financial choices. And the second thing to note is that Title III covers more than just the campus ban. It also imposes conditions on underwriting standards and advertising practices for all individuals under 21, regardless of whether they are in college or not. So our identification, as I'm going to show you in a bit, is going to focus on the impact of the campus ban alone. But more generally, to evaluate the impact of the campus ban in what we think is a comprehensive way, we're basically going to follow a three-step process. First, we're going to use administrative data to identify the treatment effects of the campus ban on student loan outcomes. As a little preview, we're going to use a difference in difference strategy, and we're going to find a positive and significant effect. Then we're going to explore the welfare consequences of this increase in student loan balances. And to do so, we're going to investigate if credit cards were used optimally to begin with. The idea being that if credit cards were not used optimally to begin with, then nudging students away from them can in principle be beneficial. But to talk about optimal use of credit cards, we need a benchmark. So we first develop a model to identify how optimal use of credit cards looks like. And we compare the behavior of students to this rational benchmark. But to do so, we need data on how students use their credit card and how they think about credit cards relative to student loans. So we run a survey among current students. We link their answers to our administrative data. And with that new data set, we compare the behavior of students to the rational benchmark. And again, just as a preview, we find that indeed students do not seem to be using their credit cards optimally. But the survey that I just described describes the behavior of current students and not the behavior of students who had a credit card before 2009. So we're going to look at the characteristics of students who have a credit card today, and we're going to look at other sources to look at the characteristics of students who had a credit card before 2009. We're going to argue that, if anything, people with a credit card today are positively selected, which makes us believe that it is unlikely that if credit cards are incorrectly used today, that they were correctly used before the ban. And finally, to confirm that the ban had a positive effect on students' lives, we are going to look at the treatment effect of the campus ban on academic outcomes, specifically GPAs and on-time graduation rates, and we're going to find a positive effect there as well. Okay, so we use data from multiple sources. The first one is administrative data from a large public university. This data carries information about student loan borrowing at the student semester level, and it also carries information on demographic and academic variables. We complement this information with data from a survey that, as I mentioned, we matched to administrative records. This survey was administered to current students in the spring of 2021, and with this survey, we investigate how students use credit cards and student loans. We also elicit time preferences and levels of financial literacy. And because we observe administrative records, we observe the zip code of the permanent address of every student, and that allows us to complement this data with zip code level information on socioeconomic characteristics from public data. So with these resources, we can proceed to look at our main identification strategy for the effect of the campus ban on student loan borrowing. So the left-hand side in our equation is going to be related to student loan borrowing. So we use a difference in difference analysis in which incoming freshmen are in the control group and returning sophomore and junior students are in the treatment group. The idea is that exposure to credit cards on campus for freshman students was not affected by the Card Act because they were not on campus to begin with. In contrast, exposure to credit card on campus again by continuing students, including sophomores and juniors, was affected by the Card Act because before the Card Act there was a lot of marketing of credit cards on campus and they were exposed to it, these continuing students. Whereas after the Card Act, that was no longer the case. So we estimate a diff in diff with a flexible specification to recover semester by semester coefficients before and after the CARD Act. We drop intermediate years in which continuing students were partially treated. And then we look at heterogeneous effects by parental income. Specifically, we interact a summary diff in diff coefficient with quartiles of parental income. Parental income comes from zip code level data from the American Community Survey. So these two graphs right here show our main results. We find that on average, students were borrowing around $1,300 per semester, including students that borrow and students that don't, before the CARD Act. After the CARD Act, there is an average effect of $105. And this corresponds to an 8% increase in student loan borrowing. But importantly, if we look at the average effect post-CARD Act by income quartile, we can see that the effect is actually concentrated on students coming from the least affluent communities. Specifically, we can see that for students that come from zip codes in the bottom quartile of the income distribution, there is an effect, an increase of $227 per semester. This represents a 15% increase in borrowing based on the pre-CARD Act levels. In the paper, we discuss several robustness analyses. In particular, we note that while we are not measuring the treatment effect of the campus ban on credit cards, there was indeed a reduction in credit card use among students, as can be confirmed by multiple sources. But now, to explore the welfare implications, we want to see if students are using their credit card optimally. But what does it mean for a student to use the credit card optimally? So in the paper, we develop a model that provides the intuition that credit cards are an optimal source of emergency liquidity. The idea is that credit cards definitely carry larger interest rates, but they allow you to access credit flexibly at any time on a pre-approved line of credit. In contrast, student loans carry lower interest rates, but borrowing decisions need to be made at pre-specified periods, like at the beginning of the semester. So if we think about it, given the prices, if there is a student that facing the prospect of an emergency, is going to choose to borrow more or less on her student loans, depending on how likely she thinks that this emergency is going to happen, depending on what the likelihood she thinks is that she's actually going to need the money. If the emergency will happen for sure, or with a sufficiently large probability, then I should definitely borrow or take out more money on my student loans for this emergency because they have a low interest rate and I'm definitely going to use the money. If the probability is low, in contrast, and I request the money from my student loan, there is a high chance that I took the money without needing it, and that carries a cost. If the probability of this emergency is low enough, students are better off not taking additional money from their student loans and instead waiting until when the uncertainty is resolved and borrow on their credit card only if they end up needing the money. So the interesting thing is that there is a clear prediction about optimality of credit card use and students' expectation of an emergency. And we're going to try to test that in the data. To begin this test, we can look at who has a credit card and who revolves on that credit card. And what we can see is that students in the top quartile of the income distribution that come from more affluent communities are more likely to have a credit card, but revolving on that credit card is more common among students from less affluent communities. In terms of what the card is used for, we can see that cards are used for a variety of purposes, including indirect expenses like textbooks or computers, also restaurants and non-essential expenses, emergencies as well, and even direct expenses such as tuition and room and board. In our survey, we also asked students how they would cover an emergency and of $500. And what we see is that when facing an emergency, again, students consider multiple sources, including student loans, including
5 minutes
credit
left.
card, or asking their family for money or using their savings. But interestingly, the probability of facing an emergency or their expectation about facing an emergency is uncorrelated with the probability of using a credit card for using for these emergencies. No? So one thing that's important to note is that even the sign is the opposite from what we would expect if people were using credit cards optimally as a source of emergency liquidity. Because remember that if the probability of facing an emergency is very high, you are better off taking more student loans in advance because you know you are going to use the money for the emergency. Whereas if the probability is very low, then you are better off using your credit card contingently. I only borrow when I have to, even if it's at a high interest rate. So this is the opposite from what we find. So to continue with this idea of whether credit cards are being used optimally or not, we look at different levels of financial literacy among current students. Specifically, we use this taxonomy of John Campbell that outlines different types of financial ignorance. The first type of financial ignorance that he outlines is ignorance of contract terms. The idea is that in this context refers to individuals not being aware of what the interest rate on their credit card is, what their credit limit is. And we find that a lot of people don't know these things, or they report interest rates that are substantially below what we would expect in the market for students like this. We also look at ignorance of concepts or financial literacy, and we do that with the questions of Ana Maria Luzardi and Olivia Mitchell. We find that a lot of people cannot answer these questions correctly, and specifically in the bottom quartile of the income distribution, in the bottom segments of the income distribution, individuals are less likely to answer the questions correctly than the more affluent individuals. The third type of financial ignorance that we look at is ignorance of financial history. That in this particular case, we find that around 10% of individuals are not aware of their own financial history. In particular, they don't know that they have money available in their student loans. We asked them if they have maxed out, and they said that they are not taking loans because they are maxed out. So these individuals think that they don't have available student loans when actually they do have available student loans for takeout. And the last type of financial ignorance that we study is ignorance of own behavior, ignorance of self, which is related to the concept of naive present bias that we approximate with discount rates and with a question about the perception of having too much debt. Across the different measures, the least affluent individuals tend to be, in general, less financially savvy. And what we do next is to correlate these different types of financial ignorance with borrowing behavior. Because we ask students if they regularly revolve on their credit card. And we pay particular attention to individuals that regularly revolve on their credit card while having unclaimed student loan balances. These individuals have not maxed out on their student loans. They have unclaimed student loan balances, and they are nevertheless revolving on their credit card on a routine basis. And we find that ignorance on concepts.
You have 1 minute left.
And to some extent, lack of awareness about available student loans are particularly strong predictors of borrowing while having these unclaimed student loans. So we think that we have some evidence that credit card use among current students is not consistent with optimal credit card use. This suboptimality we find is actually tied to financial ignorance. But as I mentioned, what we need is really a sense of how cards were used before the ban. So to make that argument, we just note a few things. First of all, there is a large decline in the fraction of college students with a credit card. Before the ban, there was around 84% students with a credit card. And according to multiple sources, including our own survey, the number after the ban is closer to 50%. Second, the credit cards are concentrated today in the top quartile of the income distribution.
Oh, so sorry, Pauline, you have 0 minutes left.
Okay, yeah. So sorry, Jeffrey. So then let me just go to conclude here. So we think that there is a suboptimal use of credit cards. So the ban helps students, and actually, when we look at it in terms of graduation outcomes, we can see that there is more on-time graduation, higher final GPA, and there's no effect in changing the composition of major. So in this paper, we argue for evaluation of consumer financial markets broadly across multiple markets. And our interpretation of the evidence in terms of the Card Act is that there is lower card use among students susceptible to financial mistakes, that they were steered towards cheaper sources of credit, and that this reduction in the debt burden actually improve academic performance. Thank you.
Okay, great. Thank you, Paulina. So next we have Dan Herbst from the University of Arizona presenting his paper, Opportunity Unraveled, Private Information and the Missing Markets for Financing Human Capital. Dan, you'll have 18 minutes, and I'll let you know when you have 5 minutes and 1 minute remaining. Please go ahead.
Perfect. Thank you so much. Really appreciate being put on the program and excited to share this work with everybody. So as was mentioned, the paper is Opportunity Unraveled, Private Information and Missing Markets for Human Capital, and this is joint with Nathan Hendren at Harvard. So our human capital is really the largest investment most of us will ever make in our lives, and yet we're typically restricted to a single method of financing this investment, and that's non-dischargeable debt contracts with the government, student loans. And this is really a type of contract that's totally suited for the kind of investment that college represents, because while the returns to college are high on average, they're also quite variable. If I go to college, I might not graduate, and even if I graduate, I might not land a great job or earn a high income. So it should come as no surprise that a lot of borrowers have trouble repaying this debt. Among 2012 borrowers, at least 2/3 experienced some kind of non-repayment event by 2017. So instead of this risky debt product, what ideally you'd have is a product that provides some amount of insurance against the risk of low returns to college. Now, physical capital markets already provide for this kind of insurance, right? If I wanted to invest in some physical capital, if I wanted to start a company, I wouldn't finance it entirely with a non-dischargeable debt contract. That'd be very risky. I'd probably take out a variety of different kinds of debt, some with limited liability and different terms and with different dischargeability in their terms. And I probably might even sell some equity in my business. That way, if it went under, I wouldn't be holding the bag. It would insure me against some of the risk of that investment. It's not hard to imagine the analog for human capital investments. In fact, the idea for equity contracts for human capital has been around for at least 75 years. You can imagine a company pays you some money up front for you to go to college, and in exchange, you pledge some share of your income down the road. In addition to some so-called earnings equity contract, you can also imagine some state contingent debt contracts, right? A contract that gives me some money to go to college, and maybe maybe it's a higher interest loan, but I don't have to repay that loan unless I graduate college or find a job or otherwise reach some state of financial security. And this way, all these kinds of contracts provide some kind of insurance against that risk of going to college. Yet despite its obvious benefits such contracts might provide to risk-averse borrowers, these types of contracts are virtually non-existent in the private market. There do exist a number of public programs like income-driven repayment or income contingent loans across a variety of countries that mimic these types of insurance qualities in these contracts. But in terms of private market products, we really don't see many contracts that provide these kinds of terms. And so the question in this study that we ask is why? Why don't we see thriving private financial markets for risk mitigating contracts to go to college in the same way we see such financial markets for physical capital investments? And the answer we give is that these potential markets or hypothetical contract markets have unraveled due to adverse selection. And we demonstrate this by first showing through a model how financial markets might unravel in the presence of private information and derive a condition under which risk mitigating contracts for college cannot be profitably bought or sold by financiers. We're going to then turn to the data to validate this model using survey data on subjective elicitations that first to just provide some evidence that private information does in fact exist in these hypothetical markets, and then to empirically test or explicitly test the unraveling condition generated by our model using these subjective elicitations and the corresponding outcomes we see among borrowers in our data. And then finally, if I have time, we'll briefly touch on the welfare impact that might accrue from programs that might facilitate these markets to open up, right? In other words, subsidies that the government might put on these risk mitigating contracts that might help borrowers realize those insurance benefits that they don't have access to due to unraveling. So I'm going to since I have limited time, I'm going to spend a lot of my talk today describing our model in as accessible terms as possible so we can all get on the same page as to what exactly we're talking about here. So here on this plot, I'm going to walk you through a graphical illustration of our model. On the x-axis, we have an index of types. On the left side here, the leftmost point of the axis, you have the sort of lowest type, the person who expects to have the lowest outcome post-college. And here on the right, you have this person that expects to have the highest outcome post-college. And for the sake of exposition, we're going to focus on that earnings equity contract I mentioned earlier, but the same logic will extrapolate to those state contingent debt markets as well. So if you imagine the x-axis here being the index of types from low to high, the y-axis is going to measure the actual expected income among each of those types. So just for this illustrative example, I'm going to imagine expected earnings are uniformly distributed between $20,000 and $80,000. So the low type here expects to earn $20,000 after college, and the high type expects to earn $80,000, and then everyone in the middle is gradually has increasingly better expectations. So now let's imagine a hypothetical contract market for this population. The contract I want you to imagine is one in which a borrower sells a quote-unquote stake in their post-college earnings at its share price, which we call lambda, right? So it's a little counterintuitive, but I want you to think here of the borrowers as the sellers and the financiers as the buyers, right? Much as you would a stock market, the financiers are buying a stake in post-college earnings at some price, and obviously the higher the price, the higher the valuation of those post-college earnings. And we're going to define the willingness to accept, or W2A curve, as the minimum share price, that minimum lambda that a given type theta is willing to accept in order to give up a share of their future earnings, right? So if borrowers are completely risk neutral, this willingness to accept would lie on top of the blue line here. Their willingness to accept would be exactly equal to what they expect to earn in the future, because in expectation, they're completely indifferent between the two. They don't see any benefit from there being less risk. Obviously, of course, borrowers aren't risk neutral. They're generally risk averse. And so we're going to imagine willingness to accept is something below that expected earnings line, right? So if I expect to earn $20,000 in the future, for example, I might be willing to accept a contract that in expectation only gives me, say, $18,000 because that contract might insure me against the risk of variable postgraduate earnings. Now, imagine a financier trying to sell a contract among this population of individuals. Let's imagine they set some price such that 50% of this market would be willing to accept. That is, set the price to be equal to that minimum reservation, that willingness to accept price for the median individual. If the financier sets that price, that borrower who expects to earn $50,000 would be attracted to this contract, right? It would make them just marginally better off. But it's not going to attract just that borrower. It's going to attract also all those borrowers who would expect to earn lower earnings than $50,000. And so the actual return on it, the actual amount of money that this financier is going to get by selling that contract is not $50,000, the amount that they get from selling to the marginal borrower, but rather $35,000, the amount that they get incorporating the cost of all the worst risks in the market. And so you can do this same logic for individuals across the entire distribution of types and scope out what we're calling the average value curves. That is the average expected income among all those willing to accept less than a given borrower's willingness to accept. And I should mention, if I haven't already, I should mention that we're imagining here a borrower of observably identical individuals from the point of view of the financier. Obviously, in most credit markets, there's some amount of risk rating, and we're allowing for that in our empirical exercises so that we can imagine a market that's residualized all that publicly available information and simply is the price quoted among a bunch of individuals that from the point of view of the financier look exactly the same. So in this market, we've scoped out an average value and a willingness to accept curve. Because the value to the financier of providing this contract is slightly higher than the willingness to accept, the financier can in fact make positive profits. But if you imagine this alternative scenario in which borrowers had more private information, let's say that expected earnings were distributed between $0 and $100,000, the story can be very different. These borrowers have the same preferences and the same future earnings. They just have a little more private information than in the previous scenario. And for this population, the median borrower is still willing to accept $35,000, but the price that the price that the financier would have to offer them must be lower than that if they want to try to make ends meet. Why? Because the average value of worst risks is now lower. The very worst types in this market know that they're going to earn less and they're going to be especially attracted to this market, to this contract. And so in this case, profits would be negative. You could think, well, why does this financier just offer a lower price so that they'd make ends meet? That won't work because then there would be fewer borrowers willing to accept. They're going to push the best types out of the market. Once again, profits are going to be negative, and so on and so forth until the entire market unravels. And so this leads us to our unraveling condition. If this willingness to accept curve is greater than the average value curve for all types, then there exists no value, no share price that the financier can quote such that all profits are positive. And so our empirical goal is going to be to estimate these two curves, because if we can show whether or not one lies above the other, that is, the willingness to accept curve lies above the average value curve, and thus test our unraveling condition. And we're going to test this unraveling condition not just for this earning equity contract that I just described, but also the state contingent loan contracts that I mentioned at the onset of the talk. Completion contingent loan, an employment contingent loan, and a dischargeable loan that's meant to simulate what a student loan with more generous discharge circumstances or discharge terms might, whether that type of contract might be able to exist in this market. So turning to the data, we're first going to simply just show whether or not more borrowers have private information, because if they don't, then we have no hope of estimating a willingness to accept or an average value curve, and it just trivially would lead to no unraveling. So first, we're just simply going to establish that some amount of private information exists, and we're going to do that using this post-secondary student survey from the National Center for Education Statistics. What this survey does is ask borrowers or ask students, a nationally representative sample of students in the freshman year in 2012, what they expect to earn later in life, and a bunch of other subjective questions about their future expectations. And then it follows those students up in 2017. It also includes a number of administrative records linked to these students so that we can categorize a number of variables into 3 different categories that we need for our analysis. First, the outcomes Y corresponding to each of these 4 hypothetical markets, that is, whether or not they graduate, how much money they make, whether or not they find a job, etc. Then we're going to have Z, the subjective elicitations that we think measure something about their private information that we can then map into future realizations to see how much private information there exists. And then finally, X, which notes all of the observable information that we're going to condition upon to try and simulate potential pricing strategies a financier might have in a hypothetical market. That is all the observable information about borrowers that financiers could use to set contracts.
You have 5 minutes left.
Thanks. So for Y, we measure annual salary from the last job they held in 2017, and we also measure completion, employment, and whether or not they've defaulted on their student loans. For Z, we have a number of subjective elicitation about future outcomes, but in the interest of time, I will skip over the details. They don't correspond necessarily exactly to outcomes. We're going to allow that for that in our latent belief estimation. And then finally, we include a rich bevy of controls of observable information that financiers could conceivably use to price contracts. And here we've categorized them into a number of different categories, ranging from those that you definitely expect an insurer to use to price contract, and those that they would be much less likely to use, and in fact some that are in fact illegal to use. So this allows us to simulate a variety of different pricing scenarios when we're considering unraveling. So if we just look at the simple correlation between elicitations and outcomes in our data, we do in fact find that these elicitations predict future outcomes. And while this plot here is unconditional, if you residualize and focus just on elicitations conditional on all that public information, we do in fact find that they still hold predictive power, suggesting that there does in fact exist some amount of private information. But is that private information enough to predict market unraveling? Well, for that, we need to turn back to our model and try and estimate these curves. First, what we do before imposing a bunch of parametric assumptions is simply estimate the average magnitude of private information in this market. That is, what is the lower bound on the average discount that an individual would have to accept an expectation in order for this market to be profitable? And skipping through the details here, we do that using residualized predictions from using both public and private information. What we find is that borrowers would in fact have to accept a large discount. They'd have to accept a pretty sizable loss in expectation in order to facilitate a market and make the financier at least make zero profits. So, for example, among those if you consider that the average salary in our sample is $24,000, it means the average person would have to pay back at least $1.27 in expectation for every dollar of financing they got at the onset. Otherwise, this market couldn't exist. Likewise, for our state contingent debt contracts, everyone has to pay some kind of premium in expectation. Otherwise, the market couldn't exist. But that's simply a lower bound. In the next part of our paper, we explicitly estimate the willingness to accept and average value curves to get a point estimation for the unraveling condition. Again, in the interest of time, I'm going to skip through that. But the model, what we do is develop a linear latent factor model, which assumes that both realized outcomes Y and your stated elicitation Z are linear functions of beliefs, and then use deconvolution methods or maximum likelihood estimation depending on the nature of the outcome variable to flexibly estimate the latent belief distribution among this population. That distribution looks like this. And then once we calculate average value and willingness to accept curves using that distribution, we do in fact find that unraveling occurs, so that if a median college goer accepts $20,000, the stake in their earnings for the insurer is only worth $12,000, right? So the college goer would have to give up 40% of their expected earnings to make their equity contract profitable. Would you be willing to accept 40% loss in expectation just to try and finance college? Well, if your preferences were constant relative risk aversion,
Sorry, you have 1 minute
risk aversion parameter of 2, you wouldn't, right? We estimate that a willingness to accept for this population is just $16,000, a sizable discount. In other words, they'd be willing to accept a sizable risk discount, a sizable loss to get that insurance value, but not enough to compensate insurers for the cost of worse risks. So the market unravels. We find the same thing for state contingent debt contracts, so that all four markets unravel. Finally, I'm out of time, but we do a welfare calculation that calculates the marginal value of public funds of subsidizing these contracts. That is, what is the net dollar benefit per dollar cost of trying to open up these markets. This MVPF incorporates the distortionary effects of the contracts, and we find that it's quite positive, at least for the earnings equity contract, and in fact exceeds 1 for all but one of our markets. And so in conclusion, we find evidence of unraveling in several markets, and we think that this suggests that markets and frictions can really inhibit economic opportunity, especially in the case of financing college. And the last thing I'll say is just to leave you with a thought experiment. Imagine that all physical capital markets investing in businesses. Imagine that the only way you can invest in your business was through a non-dischargeable debt contract. You weren't allowed to sell equity. You weren't allowed to take out different types of debt. The only way you could finance your business was through cash or through whatever the government offered in the terms of a non-dischargeable debt contract. What do you think the world would look like? We probably wouldn't have all these businesses. We probably wouldn't have nearly as much economic activity. That's the world we're living in when it comes to human capital investments. And so we think that there's really a huge potential to harnessing the power of these types of contracts through public intervention. And that's it. I will end it there. Thank you very much. I'm sorry if I went a little over time.
Okay, great. Thank you very much, Dan. So next we have Camilla Summer from the Federal Reserve Board, who will discuss the two papers. Camilla, you will have 14 minutes, and I'll let you know when you have 5 minutes and 1 minute remaining.
Hi, guys. Can you hear me and see me? Hello?
I can hear you.
Okay, perfect. And I think that somebody needs to load my slides for me because unless you want me to share them. Okay, fantastic. Thank you so much. Okay, so I'm Camilla Sommer. I'm from Federal Reserve Board. I work in the section of consumer finances. And it's a pleasure to be here today with you guys and discuss these two wonderful papers. So I just have to start with the Fed Standard Board disclaimer that whatever I say today represents only my views and not the views of the board or the staff at the board. And let's get to it. Sorry. Okay. So can you see all of the screen or not? I'm not exactly sure in terms of, because I can see only part of my screen, but I think I can move it. Okay, so I just thought that I'd start this presentation today by talking a little bit about student loans, just to set ideas in terms of what we are talking here about. So you might know a lot of these facts because that might be the reason why I've chosen this section. But currently we have about 175 trillion of student loans outstanding in the US. And the majority, like 90% of these loans are federal loans, as Dan has mentioned. So these are directly issued by the government or more recently or sort of previously federally guaranteed, like the FELP loans. If you can look here at my graph, and let's start with the right-hand side, you can actually see the issuance, the federal issuance in the gray, and you can see that, the private loans in the blue, and you can essentially see that in the early 2000s there was this huge explosion of private loans, but that has come to an end. Now there is actually quite little of it, and it's typically only issued to very high quality or like low risk borrowers. And then you also can see sort of in terms of the issuance, the effects of the Great Recession, especially here in 2007 to 2012-13, that a lot of people actually went back to school during the Great Financial Crisis. And then sort of as we have been coming out of that, the issuance has been sort of coming down. But nonetheless, what we actually see in terms of the total outstandings, and here on the right, I actually plotted the 1.7 trillion in real terms, so adjusted for inflation. You can actually see that while we are seeing some sort of a slowdown in the growth for the younger borrowers, partly because of the issuance patterns I have kind of shown to the right. There is a lot of student loan debt, and actually older households which are aged 40 plus are holding a lot of it. And so the fact that they are having so much student loan debt so quite late in their life cycle, I think it's important to realize that these are loans, historically these were 10-year loans. So if you took them in your 20s, you might have been done by the 40. So we actually see that that's not happening currently, that these loans are not being fully repaid under the original 10-year contract, partly because we are having more of income-driven repayment plans and difficulties with repayment generally. Okay, so then sort of the further, and again, Dan talked about it, the further evidence of these kind of difficulties with payments and affordability are the high delinquency rates. So here to the left, I'm actually plotting the delinquency rates by age. And what you can see is that, they are very high. So for example, about 14% pre-pandemic for somebody who is 40 years and more. Then we see sort of this huge drop-off here at the beginning of the pandemic. And this is largely an artifact of an implementation or adoption of the federal student loan forbearance. And I'll talk about it just in a second. But essentially, the delinquent student loans, not the defaulted ones, but the delinquent ones, were actually turned from delinquent into current temporarily for the duration of the forbearance period. Although obviously these delinquency rates are very high in terms of what you may think is happening in terms of sort of financial stability or private lenders who are issuing other types of debt like auto, credit card, and mortgages, their exposure to these to borrowers who are struggling is relatively low. In the event of some sort of spillover. So what is useful to know here, I'm showing for people who are having payment difficulties or sort of delinquent on their student loans. This is essentially the share of the total, for example, mortgage debt they are holding. So for example, for mortgages, it's 1%. So this is just a little bit for the background. Now, as a result of all these things, it's perhaps not surprising that student loans have become sort of one of the policy instruments lately. So for example, what we have seen, as I've said, at the onset of the pandemic, we have seen the federal student loan forbearance program, which essentially stopped required payments during the forbearance period. So you can make these loans, but you don't have to. And we are probably seeing roughly 50% of people who are qualifying for this, who are in repayment, not making payment, but we also see about 50% for actually continue making payments. There is also zero interest rate accrual on the outstanding student loan debt. Beyond this will expire, it's set to sunset on May 1st. We'll see, because it was supposed to sunset in the past already several times, but always extended. So the current is May 1st. Then, obviously you might have caught these discussions about student loan forgiveness or various degrees. It has been part of the Biden administration's agenda, for example. It has been discussed a lot, so we'll see. And obviously there is a lot of active research into questions surrounding student loans. And, as I said, we see 2 papers on this topic just today, which are really wonderful. Okay, so let me turn a little bit now to the presentations of to discussions of the 2 papers. So the first one is Paulina's card paper. So let me just sort of go a little bit over what this is about again. So, as we have seen, Paulina and co-authors are essentially looking at the interaction of early life take-up of student loans and credit card debt. And they use diff and diff, so differences and differences estimation or identification approach in a unique data, I think very unique data from a large public university. And then they actually do a really wonderful job collecting their own data, and from the same university, I believe, and augmenting their analysis with outcomes, or augmenting their study with the outcome with the analysis from these data, survey data. What they exploit for the identification is this CARDS Act, and the CARDS that was kind of far-sweeping regulation of the credit card space, but essentially the Title III provisions affected, as you've heard, young borrowers. So it made it much more difficult for credit card companies to market student loans on college campuses, and also to issue debt to students who are younger than 21. So for that, you now typically need to have a cosigner, or you have to have some sort of documented income. So I've seen it sort of firsthand when I came to college in the U.S. This was my first time to the U.S., and I remember being a freshman and being very surprised when I was walking across the campus to see all the tables set up by the pavement, which would be marketing credit cards.
You have 5 minutes left.
Okay. So then, essentially, what Paulina and her friends and her co-authors find is that the CARDS Act led to sort of an increase in student loan debt, largely through substitution of debt. So essentially, kind of the idea is that you can come to the college, you are freshmen, so nothing is really affecting you, but then you meet a credit card, you're being marketed a credit card, you take it on, and so when you are making decisions about student loan take-up for the second and third year, you essentially decide that maybe you can take a little bit less student loan debt, and you can put some expenses on your credit card, or use the credit card in the event of emergency spending. But then once the credit card then goes into effect, you come to campus, nothing changes, but then you are not presented a credit card which you could take on. And so essentially for the second and third year or beyond, you take more money out on student cards to essentially finance the same thing. So that's exactly what they find. They also find increases in on-time graduation rates and GPA, as we've heard. So this research is really suggestive of how consumer protections can steer young borrowers from more costly forms of debt, which is credit cards, to cheaper financing. And, Paulina and co-authors, they are essentially suggesting that, this the very expensive credit card debt can actually lead to different things. I mean, it weighs on people. And for example, if you don't have it, maybe you can focus on your studies a little bit better, and it essentially leads to better improved outcomes. But it is obviously just something that one channel that could be in play. It could be other channels as well. And what is very interesting in their study is that they are able to cut the results by income, by students' household background, income by the background, social economic background from which the students are coming. And they find essentially no effects for households or for students from higher income households, but they find kind of these effects to be focused or concentrated in the lower income quartiles of the distribution of these students' backgrounds. So to this, maybe one thing I'll just say is Paulina has already talked about this idea, and they sort of tested for it in the model that credit cards can provide a buffer of emergency potentially. So it may be that you don't need to take until you actually face the emergency, but they provide quite convincing evidence that actually people tend to probably revolve without necessarily thinking about an emergency. But the additional consideration, which actually Dan's presentation is speaking to, is the fact that student loan debt cannot be discharged in bankruptcy. So obviously, if you know that you will be able to repay all of your debt, you are certainly much better off with a student loan debt, which is typically cheaper than credit card debt. But if you face a risk that you may default, you actually sort of paradoxically may be better off having more credit card debt because that's something you can actually default on because it's dischargeable in bankruptcy. Last thing which I had on this paper was that, Paulina and co-authors are essentially saying that these results could be driven by this age 21 cutoff, but it also could be just ease of access. A lot of students, the age 21 cutoff is essentially, a lot of students at colleges are quite older.
You have 1 minute left.
Oh, okay. Then maybe older than 21. And so I just wanted to say that, they could be also looking at seniors in their analysis. So then I'm not exactly sure what I'm going to do with this one, but I'm just going to, maybe I can have 2 minutes. So I will just say the following. So then in her paper is looking essentially at this contract, new way of contract, which would essentially provide income insurance or insurance for future labor market outcomes. The idea is that college attendance is maybe a wonderful investment in human capital, but also entails risk of outcomes which are less than essentially bad outcomes. You may just end up having very low income post-graduation, or you may drop out from college, and which would corrupt your future earnings. So essentially kind of the world they want to kind of test for is that imagine that you have all college goers who are in need of funds. And I have pulled this down it's quite detached a little bit on some level from their paper, but I've just kind of boiled it down to expose the main idea. So you have college goers who are in the need of funds, and they are quite similar. Imagine observationally they are quite similar, but actually they know their own type, and the guys kind of test for it because they actually show that a lot of borrowers actually are quite aware of whether they will have high earnings or whether they are high completion risk or low completion risk. So imagine that these guys are having their own, they are essentially able to observe their type. Well, lender cannot observe their type. So the only way he can actually price the contract is by looking at the whole pool and testing kind of on what they observe for the whole pool of these borrowers in terms of income or completion. But the borrowers will actually observe the type, and they will set their own reservation price, which they would be willing to pay for the insurance contract, which may be quite different given that it has private information than the one that the lender would be willing to charge. If lambda is the price with which the lender would want to charge, and lambda H is the price which, for example, the high probability type, like the probability, high probability of completion type, the not drop out type would be willing to pay, and the lambda would be less than lambda H, then the market will be sustained. Essentially, the price of the contract is one that everyone is willing to accept, both the low type and the high type. But if it's the other way around, then the high types are not gonna pay for this product. They are gonna drop out of this market, and that essentially the cross-subsidization of the price, lambda, disappears, and the lender cannot make any money on it, and the market unravels. So that's kind of like the very, I think, broad picture. Obviously, the guys are having wonderful framework for this, which is much more elaborate, and you should read the paper to learn about it. So they test for this. They find that these markets, that the types of contracts they test for cannot be sustained exactly because of the private information they document. And then obviously they kind of ask, well, how this could be sustained. They look at market subsidies. Another way how to do it is through mandatory participation. So I just wanted to say that obviously if you had a system like a universal healthcare where everybody needs to participate, and you cannot opt out of the contract, then that would be one way to probably sustain it. And with that, I just wanted to thank you and sorry for running long.
Okay, great. Thank you very much. I guess we have about a minute or so left. I'll just give, if excuse me, if Paulina and Dan want 30 seconds each to respond to Camilla's comments, please feel free to do so, and then I'll go ahead and conclude the panel. And then, since we have a virtual reception after, there'll be plenty of opportunities to chat with the speakers and ask questions. So if Paulina and Dan want to talk for 30 seconds or so.
Yeah, well, first, thank you very much, Camila, for an excellent discussion, the background and the specific comments. Yeah, I think that the bankruptcy is certainly something important. The way we're thinking about it, in our survey, we included a question about whether people don't take student loans and take credit cards because one is dischargeable on bankruptcy or not. And that did not come up as a dominant answer. So at least we think that at the time of acquisition, bankruptcy is not at the top of mind of the students. We're thinking that repayment plans have a lot of features similar to the relief that one can get under bankruptcy, but it's certainly something that we should be looking at with more detail.
I'll just say that Camille did a great job synthesizing what I'll admit is a lot of content for a short session. So I'll leave the rest of my response for the Q&A time.
Okay, great. So that's all the time we have for this panel. Thank you again to Paulina, Dan, and Camilla for their participation.